Greetings and good afternoon to each one of you. Respected guests, our esteemed delegates, comprising of constituent members, senior officials from RBI and banks, and various business groups. Ladies and gentlemen, hope you all had a comfortable journey to this wonderful city and also had good time today in the first half. Get used to the cold weather and the strong winds over here. Thank you for sparing time to attend this 19th FEDAI annual conference. To begin the proceedings, may I request our chairman, Shri Samir Sahni, to escort Shri Rajeshwar Rao, Honorable Deputy Governor, Reserve Bank of India, to the dais. May I request our chairman, Shri Samir Sahni, to please welcome our respected Deputy Governor with a bouquet of flowers. Before we start the proceedings, I would also like to put on record our thanks, gratitude, and also extend our hearty welcome to other esteemed guests for the day. May I request Mr. Prasanna from ICICI Bank to please hand over a bouquet to Shri Rama Mohan Rao Amara, Managing Director, State Bank of India. Prasanna, please. A bouquet for Shri Radhasam Rath, Executive Director, Reserve Bank of India. Prasanna, still not over. We are behind you. Dr. Aditya Ghia, CGM in charge, Foreign Exchange Department, Reserve Bank of India. And Ms. Dimple Bhandia, Chief General Manager, Financial Markets Regulations Department, Reserve Bank of India. Thanks, Mr. Prasanna. Thank you. So participation in such large number of so many senior like-minded professionals here today is a source of immense pleasure and encouragement to all of us at FEDAI. It's a strong indication of your quest for knowledge sharing, capacity building, and market development. We do strongly believe such events help build mutual trust and improve transparency, the key requirements to stay competitive in this ever-evolving world of international trade and finance. To begin the proceedings for the day, may I invite our chairman and Chief General Manager, State Bank of India Global Markets, Shri Samir Sahni, to please come over here and deliver his welcome address. Over to you, sir.
Thank you, Sindhwaniji. Respected Deputy Governor, Shri Rajeshwar Rao, sir. MD, State Bank of India, Shri Ram Mohan, sir. And Executive Director, R.S. Rath, sir, from RBI. The 19th conference of FEDAI it has seen participation in never ever seen numbers. This is the first time we have more than 300 people assembling at one place. Lovely place, Switzerland in Zurich. So we have all assembled here. It is with immense pleasure and proud privilege to welcome all of you, give you a warm welcome to the 19th Annual Conference of Foreign Exchange Dealers Association of India, being held in this vibrant city of Zurich, Switzerland. Zurich embodies a rich legacy of banking. In fact, it was one of the oldest banking centers and international trade. Its dynamic business environment, coupled with its stunning landscapes, I'm sure you would have had the first glimpse of that, and cultural charm makes it an ideal setting for this prestigious gathering. This year's conference has seen unprecedented participation. I gave the numbers which have never been, we also did not expect it to be that way, but we have seen a humongous response to it, reflecting the growing engagement and interest from our members and shareholders. Over the years, FEDAI has remained steadfast in its mission to foster the orderly growth of forex markets in India and support the expansion of India's international trade. Our unwavering commitment to promoting transparency, compliance and best practices continues to drive our efforts in enhancing the efficiency and resilience of the forex ecosystem. I will now want to get into some accomplishments of FEDAI, what we have achieved in the year which has passed recently. We continue very vigorous engagement with the regulators and policymakers. FEDAI actively collaborates with all regulatory bodies and policymakers, different departments of RBI, providing valuable insights after obtaining the feedback from various market participants. These are very valuable insights on all regulatory initiatives. We have been submitting comments and recommendations on critical draft regulations, including those related to hedging guidelines and proposed draft trade regulations and directions. This is something which was done over the last year, which has been a way to put forth the views or the comments or the requirements of various market participants to the regulators. We have also collaborated with ISDA, this is the second engagement, to conduct joint sessions for members falling within the scope of margin requirements. As we all know, 1st of April, India will see the initial margin, variation margin has already come in. So for that, we have been engaging with ISDA at various levels. From FEDAI side, many of the members had extensive deliberations with ISDA. Additionally, we have also engaged in dialogues with members, all the member banks, to enhance their understanding and preparedness regarding collateral management for NCCDs, ensuring that they are well equipped to comply with regulatory expectations and manage margin obligations effectively. The second initiative which FEDAI has been taking regularly, and we have actually enhanced it last year, was training and evaluation programs and capacity building. Our commitment to knowledge dissemination among members remains very strong, and it is unwavering. FEDAI has successfully conducted numerous webinars and training sessions focusing on key areas of forex and trade finance, including but not limited to foreign exchange management and international trade, prevention of trade-based money laundering, trade finance and documentary credits, FEMA compliance and audit, treasury risk management, capital account transactions, SWIFT operations and customer security program. These are well attended by the delegates from various member banks, and I believe they have been benefiting by it. During the financial year 2024, FEDAI also conducted 41 trading programs, both physical and virtual, alongside our flagship 5-day orientation workshop for member banks. A total number of 2,861, which is a good number, from 86 member institutions attended these programs. In the current financial year also, 51 training programs have already been conducted, attended by 2,015 officials from 80 member banks. These programs are designed to equip our members and their officers with the essential skills, enabling them to navigate the dynamic financial landscape and stay ahead in an increasingly complex and evolving regulatory and market environment. Third initiative is interactive initiative. FEDAI actively promotes engaged learning through a range of interactive initiatives, including daily quiz and weekly quiz, enhancing knowledge retention to regular assessments. In fact, it has become a pastime for me. Whenever I find some free time, I go to FEDAI just to relax. And I encourage all of you to try that. These are actually mind-breaking, but we can actually use these. The second one is a monthly newsletter providing updates on regulatory changes, market trends, and industry insights. And then we have the monthly discussion forum, which is a platform for members to exchange ideas, discuss challenges, and share the best practices among themselves. Additionally, we have also updated our study material to ensure it remains comprehensive and up to date. Right now, it is updated till December 2024. This online resource empowers treasury and trade professionals by deepening their understanding of local regulations, global industry standards, and best practices, equipping them for an evolving financial landscape. We also started a new initiative, which is a digital innovation, FEDAI Quest. The name is FEDAI Quest. On our 7th annual day, which was held on 21st August 2024, FEDAI has launched FEDAI Quest, which is a ChatGPT-based search application designed to enhance accessibility to authentic and domain-specific information. FEDAI Quest is ingested with credible and authoritative sources. The sources are also given, the links are given over there. It is told from where the information is coming in, which enables the members to retrieve reliable information very quickly on forex markets, trade finance, regulatory updates, and industry best practices. This initiative underscores our commitment to digital innovation and knowledge empowerment. One request I would like to make from this forum is to encourage member banks to increase the usage. We have seen usage, which is good, but I think there is a whole lot more we can do. We have invested quite a lot in technology over there. Next one is the ethics and governance standards. FEDAI's leadership in market integrity. We have taken over a leading role in strengthening ethics and governance standards within the forex market. As a private participant of the Global FX Committee, GFXC, FEDAI is committed to enhancing market awareness, expanding its reach, and fostering a deeper understanding of the ethical and governance principles outlined in the Global FX Code. With active participation from members and buy-side institutions, we have also successfully incorporated INDFX Code Participants Association, which serves as the umbrella body for the India FX community, IFXC. Through greater outreach and broader engagement, particularly with buy-side participants, IFXC aims to strengthen industry best practices and foster a more transparent and well-regulated forex ecosystem. Our commitment to ethical excellence and robust governance remains steadfast as we continue to drive meaningful improvements in the financial landscape. The last one is not the least but very important is industry engagement. We have been actively participating in industry forums, working groups and outreach programs, collaborating with key stakeholders to enhance market awareness and coordination. Our engagement extends to town halls and industry events organized by esteemed institutions such as number 1 Reserve Bank of India, RBI, FEO, Federation of Indian Export Organizations, IBA, Indian Banks Association, IFSC Authority, IFSCA, ISDA, ICC, etc. And these are done at different locations as well. These interactions play a crucial role in knowledge dissemination, streamlining processes, and strengthening industry-wide coordination. By fostering a deeper understanding of regulatory requirements and global market developments, FEDAI contributes to the harmonization of best practices and ensures that Indian forex markets remain aligned and are equal to the international best practices and standards. We are also actively collaborating with FIBIL, Financial Benchmarks India Private Limited, in the development and administration of benchmarks for money markets, government securities, GSECs, and forex markets in India. Our goal is to ensure that these benchmarks are free from any kind of bias, supported by robust data-driven research, and aligned with the best global practices. We remain steadfast in our vision of fostering a robust, transparent, and efficient financial ecosystem. As we gather here today, let us collectively contribute to the continued growth, stability, and prosperity of our financial markets. I thank each and every one of you, and I wish you a very productive, insightful conference and an extremely pleasant stay in Switzerland. Please, after the conference is over, enjoy the beauty of this beautiful country, and thank you all once again for coming over here.
Thank you, sir. Thanks for your kind words. Thanks for your continued leadership. I must acknowledge over here, without the continued support, guidance from you as well as from all the members over here, we won't have been able to achieve what you all enumerated over here. Thank you very much, sir. Now, moving forward, it's my pleasure and with sense of great pride, I would like to introduce our distinguished guest and keynote speaker for the day, Shri Rajeshwar Rao, Honorable Deputy Governor, Reserve Bank of India. I don't think I need to give any introduction to such an eminent personality, but still, as my duty, I think it would be proper I give you a brief recall of his career in Reserve Bank of India, which started in 1984, where he has held diverse array of key positions throughout his distinguished career. In his current role, Shri Rao oversees several critical departments: Department of Regulation, Department of Communications, Enforcement Department, Legal Department, and Risk Monitoring Department. Shri Rajeshwar Rao has got extensive experience in banking and financial sector and leadership capabilities and continue to contribute towards growth and shaping of India's financial landscape. And just as a proof of what all Reserve Bank of India, or the current team of Reserve Bank of India is doing, I would like to share with you a latest development announcement of today, wherein Reserve Bank of India has been selected for Digital Transformation Award 2025 by Central Banking London. It's clearly the award is a recognition for its initiatives, including Pravaha and Sarthi, the systems developed in-house by Reserve Bank of India, reducing the paper-based submission. So this is one of the many achievements which Reserve Bank of India has done and has been continuously doing. And obviously we couldn't have anybody better than Shri Rajeshwar Rao to come share with us and give us some guiding notes and directions in this, what all we can look forward to. Sir, very happy to have you here. Welcome you to the dais, sir.
Mr. Sahni, Chairman FEDAI, Mr. Sindwani, CEO, Mr. Ram Mohan, MD of SBI, ED Ratho, my senior officers from the Reserve Bank of India, distinguished delegates to this conference, ladies and gentlemen, a very good afternoon to all of you. I'm very happy to be here amidst all of you at the 19th annual conference of the FEDAI. And this is an annual event which provides an excellent opportunity for a fruitful exchange of ideas and thoughts among the foreign exchange market participants. And I'm sure this conference too comes at an opportune time. A lot has changed since the last conference. The world has seen a synchronized easing of interest rates by central banks of major advanced economies, as they have seemed to reach the last mile of their fight against inflation. This easing cycle comes in the backdrop of continuous hikes by central banks as they grappled with multi-decade high inflation following the accommodative policy measures aimed at ameliorating the cataclysmic effects of the pandemic and the subsequent supply chain disruptions amidst the conflicts in Eastern Europe and Middle East. With the new administration taking charge in the United States, the specter of a trade war is now looking over our shoulders, and the world is seeing an unraveling of the Washington consensus. This has the potential of fragmenting supply chains with further increases in the trends for friendshoring, reshoring, and nearshoring. The likely fiscal and trade policies of the new US administration also has led to a recalibration of the monetary policy outlook, with the markets divided over the expectations of future cuts in the current calendar year in order to contain potential inflationary pressures. This has also led to a repricing of US Treasury yields along with sharp volatility in the US dollar. For the emerging market economies, this could mean an exacerbation of the capital outflows and depreciation of currencies, which could pose challenges from the point of view of financial stability. When we look back from 1980s to the mid-20s, 2007 is now etched in economic history as the era of great moderation. marked by substantial decline in macroeconomic volatility. This period of low volatility, as measured by various metrics, improved the functioning of markets, moderating economic policies, and reducing allocation of resources for hedging of risks. Historically, benign conditions often serve as a catalyst for market participants to take on more risks, thereby leading to conditions that could potentially exacerbate the risks to financial stability at a future point in time. The volatility paradox hypothesis states that the loose financial conditions motivate agents to take more risks and increase their leverage, which contributes to making the financial system more fragile. Events over the last 2 decades bear that out, with the global financial markets facing multiple crises during the periods, starting with the global financial crisis in 2007 and 8, followed by the Eurozone sovereign debt crisis, followed by the taper tantrum, and then, of course, the Brexit referendum in 2016. Just as the markets began to fully absorb and price in the impact of these events and was looking for calmer waters ahead, 2 significant events occurred in quick succession. One is the outbreak of the COVID-19 pandemic, and second was the war in Ukraine. Each of these crises had different causalities. The period of low volatility during the Great Moderation led to buildup of global financial crisis where risks were amplified through buildup of excessive leverage. The increase in banking sector leverage was certainly a side effect of low market volatility, particularly in the US and the Euro area. The crisis had its roots in the housing bubble, subprime lending, and associated light touch regulation, which spilled over into other financial markets through layers of complex structured products. While the crisis affected the world at large, its epicenter lay in the advanced economies. In 2013, however, the emerging market economies, especially the so-called Fragile Five, India, Brazil, Indonesia, South Africa, and Turkey, encountered heightened turbulence, with investors shunning the countries as an asset class amidst the so-called taper tantrum. This perceived flight to safety was prompted by an unexpected announcement by the then Federal Chair, Bernanke, that the quantitative easing program of the Fed would be tapered by the end of the next financial year, as the US economy had recovered sufficiently from the crisis. Brexit, on the other hand, was driven by concerns around sovereignty, immigration, the economy, and the anti-establishment politics. The beginning of the current decade saw the world confronted with a once-in-a-century problem, the outbreak of the COVID-19 pandemic that sent shockwaves across the world economy and triggered the largest global crisis since the Great Depression. Hard on its heels in 2022, just as the world economy seemed to be slowly recovering from the impacts of the pandemic, came the conflict between Russia and Ukraine, which disrupted the global supply chains and led to a surge in commodity prices, including crude oil. The after effects of the loose financial conditions during the pandemic, along with inflationary shocks of war, led to conditions of inflationary pressures in the advanced economies of unprecedented magnitude in recent times, leading to coordinated policy hikes by the most advanced economy central banks as they battle to abate the inflationary pressures and prevent inflationary expectations from being entrenched. During these bouts of risk-off events, markets remained volatile, with the CBOE VIX, a popular measure of stock market's expectation of volatility, rising to a level as high as 59.89 in October 2008 in the aftermath of the GFC, and to 53.54 at the onset of COVID in March 2020. This is in contrast to the historical average of about 19.31 during the period 2000 to 2025. Similarly, the MOVE index, which helps investors track volatility across US Treasuries, also touched its all-time high of 214 in November 2008 from the levels of around 58.9 during the middle of 2007. During the taper tantrum, the index touched the level of 103.52 in August 2013, 109.6 in February 2020 around the time of the Brexit and early days of COVID. Thereafter, it trended lower and touched a low of 39.21 in September 2020, amidst a series of policy measures initiated by central banks to support the economy from the vagaries of the pandemic. It has since inched higher and has been trading in the range of 86 to 148 since 2022 on account of the continuing global political uncertainty and more recently amidst the rising trade tensions underscored by the Trump's proposals for tariff. Another index developed by Goldman Sachs, which measures the global financial conditions, tightened to a level of more than 104 during October 2008 from less than 100 during the prior period. Given these trends, the last 2 decades could perhaps be characterized as an era of great volatility following the era of great moderation. Over the past 2 decades, we have seen a closer integration of global financial markets with the shocks in the major advanced economies often spilling over to the rest of the world across multiple asset classes. While the Indian financial markets did react in sync with the global developments during each of these crises, the extent and degree of impact was progressively lower, an outcome perhaps of the various longer-term measures taken over time to bolster the markets and the economy at large. The currency typically acts as the first line of defense as the recipient and absorber of shocks during these periods of turbulence. For example, at the peak of GFC and during the taper tantrum, the rupee slumped by more than 20% against the US dollar in a matter of months. However, in each subsequent crisis event, it weathered the risk-off sentiments much better with significantly less impact. While in the initial days of the pandemic, the rupee depreciated by 7%, geopolitical tensions emerging out of Ukraine and a synchronized hike in policy rates by the major central banks since 2022 till the middle of 2023 resulted in rupee losing about 10% against the US dollar. The subsequent period has been no different, with the Indian currency weathering the political risk emerging out of the Middle East and the uncertainty of the US presidential elections and the subsequent policy issues and its subsequent impact on trade relations. Market sentiment towards a currency can be gauged through the implied volatility metric, which is largely a function of the economic parameters, the depth and resiliency of markets amongst the various factors. On this parameter, while the spurt in the 1-month implied volatility of rupee during each of the risk-off events has seen lower peaks, the long-term trend as such has also been on the lower side, which indicates improvement in the robustness of the forex markets. In fact, Indian currency has been one of the least volatile currencies in recent times, bearing testimony to the innate resilience of our macroeconomic fundamentals. The government bond market has also gained depth over time, with an average bid-ask spread being amongst the lowest among the peer nations. The yield curve, often alluded to as a public good, has also evolved in an orderly manner, with its tenor extending to 50 years, which is not a common feature globally. Even in the terms of volatility, measured either in terms of its absolute movement or standard deviation, our bond markets have performed significantly better when compared with many advanced and emerging economies. The equity markets volatility measured through VIX has also remained well anchored, barring episodes of global risk-off events. The Reserve Bank over the years has deployed a wide array of toolkits, both conventional and unconventional, to navigate through episodes of market turmoil. As each such episode seemingly emanating out of a unique set of circumstances, the policy learnings, the responses have to be tailored, proactive, and specific. The learnings imbibed from those episodes have, however, been carried forward and have been used to deliver better responses to such future events, as we shall see going forward. If we go back in time and start with the global financial crisis, the policy measures in response to the episodes focused on maintaining adequate system liquidity, strengthening the forex reserves, and ensuring a robust crisis management framework. Conventional tools such as the policy rate adjustments and cash reserve ratio modifications or calibrations were also deployed. Forex liquidity was managed by easing interest rate caps on foreign currency deposits for non-residents and liberalizing the external commercial borrowing norms for corporates. Following the Fed's announcement of an early tapering of the quantitative easing in 2013, Reserve Bank took decisive steps to restore market confidence and stabilize the rupee. Monetary conditions were tightened using unconventional tools, while the forex management involved direct intervention and administrative actions. Key measures included import restrictions on non-essential items, a special dollar swap window for the PSU oil companies, a concessional FCNR-B facility, higher overseas borrowing limits for banks, increased foreign investment in government debt, and restriction on outward investments, which helped to ensure financial stability amidst external pressures. The biggest improvement drawing from these lessons was the institutionalization of the formulation of monetary policy in India. This eventually led to establishment of the Monetary Policy Committee and the adoption of the flexible inflation targeting system. Excuse me. During the outbreak of the COVID pandemic in 2020, policy measures were aimed at swift redressal of the emerging and potential market dislocations. Chief among them was reduction in policy rates and prompt availability of adequate quantum of liquidity to help the market participants to tide over the crisis. To improve transmission of policy rates and ensure flow of credit to the affected sectors, unconventional measures were used, such as the long-term repo operations, the targeted long-term repos, and special refinance facilities to all India financial institutions. A special liquidity facility was also introduced for the mutual funds aimed at dissipating redemption pressures, not the same and yet not too dissimilar to the measures rolled out during the global financial crisis, reflecting the lessons learned, as I said earlier. Our response during the pandemic was also notable in its increased emphasis on timely forward guidance and effective communication strategies to assuage market concerns. Just as the risk sentiments began to recover from the lows of the pandemic, the war in Ukraine broke out. The unexpected escalation of war led to surge in market volatility globally, marked by a rise in commodity prices and inflation to multi-decade highs. As major central banks embarked on synchronized monetary tightening in response, the financial market volatility surged, placing significant pressure on the rupee. Our actions at this time were focused on measures aimed at enhancing inflows through incentivizing non-resident deposits, foreign investment in debt instruments, and ECBs. To promote exports and support the objective of internationalizing the rupee, additional arrangements for invoicing, payment and settlement of exports and imports in rupees were also put in place. While the rupee did depreciate amidst tighter financial conditions in the aftermath of the war, the measures outlined above ensured that the decline was in an orderly manner. While the measures outlined above were more direct in nature, aimed at effectively responding to particular crisis events, the sight of long-term development of markets was not lost sight of. Steps were taken continuously for increasing the breadth and depth of the market. In this context, let me touch briefly on some of the regulatory reforms and initiatives that we have ushered in over the years to future-proof our markets and institutions. During the recent times, we have taken several regulatory measures to ensure resilience and stability of markets, which include putting in place regulatory frameworks for benchmark administrators and electronic trading platforms, robust governance requirements for market makers in the OTC derivative market, user classification frameworks for forex derivatives and margin requirements for non-centrally cleared derivative reform transactions, permitting banks to operate in the NDF market and allowing them to operate 24/5, as well as expanding access of non-residents to domestic markets. A key infrastructural initiative earlier on was the formation of the Trade Repository in 2007, which helped to bring about better transparency and risk management in OTC derivatives, while also proving its worth in containing undue spillover effects of the various global and domestic crises on our institutions. Reserve Bank has also striven to facilitate state-of-the-art infrastructure for trading, settlement, and timely dissemination of information on government securities, money markets, and derivatives. Concomitantly, the regulatory system has been strengthened over time in keeping with the changing global landscape, ensuring that the regulations are aligned with international standards. We are also transitioning from a rule-based to a principle-based regulatory framework to allow regulated entities to have greater flexibility and operational freedom in determining the risk appetite within the overall ambit of market stability. As a part of our policy framework, we have been following a twin peak approach towards regulation, assigning importance both to the prudential and to the conduct-related issues. We have harmonized regulations for the non-banking financial companies, bringing them on par with the banks through the scale-based regulations in order to ensure a level playing field. On the liquidity and risk management front as well, guidelines on risk capital and liquidity ratios have ensured that our banks are in alignment with the global standards and are well equipped to handle any black swan event in the foreseeable future. To summarize, Reserve Bank has always tried to stay nimble, sure-footed and proactive in its approach amidst the myriad challenges posed in recent years, and shall remain committed to the objective of fostering stability and trust, being the bedrocks for the strong financial ecosystem. It is satisfying to see that our financial markets have proven to be extremely stable and resilient in face of multiple headwinds encountered over the past few years. Being a FEDAI event, I thought I will focus specifically on some of the key highlights seen in our foreign exchange and derivatives market, which would give a perspective on how the markets have evolved and matured through these challenging times. In the forex markets, the average daily turnover, which is a useful proxy for the size of a market, has increased from around $30 billion in 2020 to $50 billion in 2024. That's a growth of nearly 66%. This growth has been earmarked by increasing participation of non-residents as well as the growing size of our international trade. Our internal reviews have also shown that India's foreign exchange markets are highly competitive, with growth being broad-based, which augurs well for transparent and efficient price discovery. At the same time, the dollar-rupee exchange rate has been amongst one of the least volatile when compared to our peers, which I mentioned earlier. What is truly remarkable is that in this phase of impressive growth and stability, this has been achieved despite the tremendous uncertainty prevailing across the world. In March 2020, as part of our endeavor to encourage onshoring of global FX trades in the rupee, Indian banks were permitted to offer non-deliverable derivative contracts involving the rupee or otherwise to persons not resident in India. Over time, the guidelines have been further streamlined to allow residents access to such contracts. Since June 2020, when these trades were first permitted, the daily volume has grown sevenfold to around $7 billion in the recent period, while the number of entities participating in this segment is also increasing. As Indian banks have started to participate actively in the offshore market segment, the segmentation between the onshore and offshore markets has also got reduced, reflected in the narrowing spreads. The change in the regulatory framework for FX markets during the last few years has permitted the introduction of bespoke products to meet the specific needs of the users, while allowing significant growth in plain vanilla FX options and strategies in the interbank and client segments. Even as structured and exotic products and a variety of special cost reduction structures have been developed in the markets, the approach to introduction of such products appeared to be circumspect, which is welcome. Caution and higher levels of due diligence are indeed warranted when dealing with products with asymmetric payoffs. Market participants and users also appear to be conscious and responsive to the market fundamentals, choosing their hedging product basis the market conditions, with preference for cost reduction structures during the period of rupee stability, and for more plain vanilla products when the global headwinds induce greater volatility in the domestic FX markets. The Reserve Bank, on its part, has tried to ensure that while the innovation gets a legs up, the participants are also mindful of the risks inherent while dealing with them. The impact of these measures have been seen in the real sector, where the hedging patterns of economic agents have evolved and have become more nuanced. At an aggregated level, including trade exposures as well as the exposures from short-term finance and other exposures, the data suggests that the hedging of the real sector has improved compared to exposures which were left unhedged during 2021-22. At a granular level, there is a marked change in the hedging behavior of corporates. While percentage of hedging by exporters has seen a downtrend, on account of sustained depreciation of the rupee. A higher percentage of import exposures are being hedged on account of its reduced cost amid marked stability in the rupee. In recent times, as rupee volatility has picked up, primarily on account of global factors, the transaction data in the forex forward segment indicate increased hedging activities by exporters and importers. It is interesting to note that entities with exposure to forex on the liability side who are more vulnerable during the periods of downside bias in the rupee have been increasingly entering into hedging contracts which are of longer tenor. All of this suggests that the responsive behavior of the market participants in the buy and sell side alike, which from a regulatory standpoint is a very heartening trend. The market innovation has not been confined just to FX. Various policy initiatives and efforts have been taken in the area of derivatives and development of the financial systems and markets therein. The rupee interest derivative market has grown over the years primarily to meet the hedging needs of the financial and non-financial sector, with the notional value of outstanding contracts rising from 37 lakh crores in January 21 to about 119 lakh crores in January 25, with both interbank and client transactions increasing in tandem. While the MIBOR-based overnight index swap contracts continue to remain the predominant instruments, other interest rate derivative instruments such as the bond forward rate agreement contracts and the total return swaps with G6 as the underlying are being transacted in the market as well, each developing in response to succeeding policy initiatives and differing hedging needs of different types of users. Similar innovations and adaptations have been seen in the corporate bond market, with the increasing issuance of bonds based on floating rates such as the T-bills or the repo rates. In fact, the domestic market has continuously adapted itself by traversing from one turmoil to another during the decades. While regulatory measures come as support wherever necessary to provide a level playing field, the market and market participants have innovated themselves to manage risks and complement the growing needs of the economy. In the financial markets, these have led to greater efficiencies and better price discovery. In the recent few years, India has shrugged off inhibitions and has marched more confidently towards achieving her rightful place among the pantheon of nations. Going forward, in our endeavor to achieve the advanced economy status by 2047, the resoluteness of our financial markets assumes paramount importance. Against the backdrop of the world economy facing bouts of financial volatility, the Indian economy is marked by macroeconomic and financial stability, with the Reserve Bank playing a pivotal role in this process. Today, it does feel that our financial markets are standing at a key inflection point in their journey. The global monetary tightening cycle appears to be complete, and liquidity conditions seem to be broadly easing out, providing hope for a rebound of the famed animal spirits. Yet, risks always lurk around the corner, especially with the specter of tariffs and sanctions, growing realpolitik and deglobalization looming ever so large. Seen in that context, the importance of staying vigilant and preparing for the future through building a robust and resilient regulatory and market framework cannot be overstated. On its part, Reserve Bank has remained committed towards ensuring that our markets are continuously evolving by adopting reform-centric regulations backed by robust infrastructure and risk management practices. In our journey towards this aspired destination, we have miles to go before we could think of resting on our laurels. So let me end with a few lines from Robert Frost from his timeless poem, The Stopping by Woods on a Snowy Evening. The woods are lovely, dark and deep, but I have promises to keep, and miles to go before I sleep, and miles to go before I sleep. Thank you very much.
Thank you very much, sir. Thanks for your words of wisdom with adequate degree of caution, I must say. May I request our chairman, Shri Samit Sahni, sir, to please offer a memento to Shri Rajeshwar Rao, sir, a token of our respect and appreciation for him. Normally there is a saying that people who don't learn or who forget the history end up paying a heavy price for that in the future. Thanks very much, sir, today for taking us through the history of the financial market, the era of low volatility, great moderation, benign conditions, how it gave birth to the volatility paradox hypothesis, which currently we are seeing through. We went through the phase of risk, amplified risk and excessive leverage. And I think the great word what you said explained it very correctly, that we are right now going through the era of great volatility following the era of great moderation, and how the regulatory reforms initiated by Reserve Bank of India and the decisive steps taken by the bank RBI has led to orderly and smooth development and growth of the market. And as I said initially, it was a well explained, taking us through the journey of the financial markets with words of wisdom and also caution, remembering about the animal spirit and trying to be vigilant in this word, especially without compromising on the innovation. Thank you very much, sir. A big round of applause. And after that speech, a regulator's perspective about the market dynamics, challenges to the financial stability. And I think it's always interesting and better to get that practitioner's perspective also about how we all as a practitioner are taking care of all these things, how we are trying to ensure that growth and orderly conduct of the market in this increasing era of complexities, and making sure that things continue to be on the right path in the right direction. And for that, I'm pleased to invite Shri Ramamohan Rao Amara, Managing Director, State Bank of India. Shri Ramamohan Rao, sir, has over 3 decades of experience with country's largest and oldest banking group, where he has handled several key assignments in India and abroad. Shri Rao amassed immense international experience working in markets like Singapore, United States. While heading SBI California operations, he turned it around, making it profitable with significant improvement in the risk profile. He is currently Managing Director of State Bank of India, the role he assumed in December 24, overlooking international banking, global markets, and treasury operations. I'm very happy to invite Shri Ramamohan Rao, sir, to address us today on this occasion.
Thank you. Good afternoon, everyone. Respected Sri Rajeshwar Rao, Deputy Governor RBI, Sri Radha Shyam Ratho, ED RBI, Senior Management of RBI, and fellow bankers, delegates, FEDAI leadership. It's a pleasure to connect with all of you. And first of all, let me thank FEDAI for inviting me to this 19th annual conference. And incidentally, this is my first participation in FEDAI conference, never participated before. But I was pleasantly surprised to see such large-scale participation from the industry and other organizations. After a very comprehensive talk by Rajeshwar Rao sir, I don't want to venture into those areas. So my talk will be more like at a very macro level, more around the markets and what kind of factors are there which are contributing to the uncertainty or the challenges in terms of strategizing what we do in the financial market. So I will be specifically covering emerging world order, US as a source of uncertainty, rapid changes in the technology landscape, and navigating the uncertainty, volatility, plus of course the Trump factor. So a couple of words around FEDAI. FEDAI has been playing a crucial role in the evolution and stability of Indian forex markets, working closely with the RBI for the development of Indian forex markets and as a representative of the industry's voice. India's financial markets, like the global economy, are undergoing seismic shifts. The interplay of geopolitical tensions, technological advancements, regulatory changes, and macroeconomic uncertainties has created a complex landscape for markets. As the theme of this conference says, the current world order is in flux and a new order is emerging. The rise of multipolarity, the reconfiguration of supply chains post-COVID, of course, the ongoing wars, the Russia-Ukraine war or the Middle East crisis, it is giving rise to a lot of tensions. It has created an environment of heightened uncertainty. Of course, the traders, I think there's a constant discussion when when it is completely stable market, there is very little scope for the traders to make money. But when there is volatility, obviously, it is expected that traders will make money. But I think we are in a very peculiar situation, compounded by the fact that the flip-flops, what we are seeing around the tariff, etc., is actually definitely has set in a fatigue. And perhaps I am fresh from attending another conference yesterday. It's called EBEC, European Bank Economic Conference, where I think it is mainly the delegates are from Europe. And as expected, with the kind of withdrawal of support from a trusted ally like US, Europe is figuring out as to what is the next course of action. Already a couple of announcements were there. They want to increase the spend on the defense, etc. There was one session where two ex-chief of staff of US president attended an interactive session. And the point of discussion or the curiosity for the entire delegates was how the decision making happens in White House. This is what I'm speaking is outside the text written. This is more around what is the difference between Trump version 2.0 versus version 1.0, Trump 1.0. I think two things come out very clearly. I think one of the ex-chief of staff was very categorical in saying like what you see is what you get with regard to Trump. That means Trump on the screen and off the screen, both are same personalities. There is no change. That is what he said. It is up to you to figure out what does it mean. Second thing is, of course, like the time-tested practices, what they had in the White House around deliberating on complex issues, consulting with the stakeholders, which typically takes weeks together before a decision is consummated. I think they have been given go by. So that's the reason you see a flurry of activity, flurry of statements only to be withdrawn immediately within no time. And then the market also reacting to those changes. I think this as a aside, just I'm sharing with you. Let me come to the new emerging world order. So let me talk a bit about the emerging new world order. The world order, led by the wealthy Western nations, has been under challenge from the rise of emerging market economies like China and India. While both the developed and EM, that is emerging market economies, have grown, the latter have grown faster. The emerging market economies have doubled their share in global GDP since 2000. And as per IMF, the emerging markets which are part of the G20 now account for 30% of the global output, as well as 25% of global trade. If we expand this group to what is known as the emerging market and developing economies, what they call EMDEs, they have overtaken the contribution from advanced economies. During 80s, the EMDs accounted for 37% of the global GDP based on the purchasing power parity, while advanced economies made up 63%. But by the year 2023, the share of EMDs has surpassed that of advanced economies, reaching around 58%. Given the weak growth in many of the advanced European economies in the last few years, this share is likely to increase or continue to increase. So what does it mean? This rebalancing has significant implications, not just at the geopolitical level, but also for financial markets. For long, we have heard in the financial markets that when US sneezes, the rest of the world catches cold, right? I mean, all of you would have heard it multiple times. But simulations done by IMF show that the same may now be true of some large emerging market economies as well. So particularly China. Any news around China slowing down or performing or outperforming has an implication for the markets. So as per IMF, the spillovers to growth from shocks originating in the G20 emerging markets can explain as much as 10% of the output variation in other EMs after 3 years and 5% of output variation in advanced economies. Over the years within EM universe also, we have seen changes in leadership. While China led the growth mantle for emerging markets during 2000s, the 2010s were a period of transition, with India slowly taking over the role of being the growth leader among the major EMs. Now in the 2020s, India widely recognized to be leading the next phase of growth among major economies. These changes in the economic world order have a massive impact on investor decisions and hence on the capital flows. Sir has covered the capital flows part very extensively. We have already seen global bond indices, including Indian government debt, and while the recent FPI outflows from the equity market may have led to some concerns, the fact that despite the correction, Indian equity valuations remain higher than most other countries is a testament to the continued high growth expectations from investors. US as a source of uncertainty. While the role of emerging markets in the new emerging world order has been increasing, one advanced economy that has been able to maintain its strong contribution has been the US. But at the same time, US Fed has expanded its balance sheet while the US government debt has also ballooned. Before the 2007-8 global financial crisis, US Fed's balance sheet size was less than $1 trillion. To support the economy through the crisis, over the next 6 years, Fed increased its balance sheet size to $4.5 trillion. By 2019, it managed to reduce it to $3.8 trillion, but then COVID happened and the Fed balance sheet has increased to $8.9 trillion. So it has since been only able to reduce it down to $6.76 trillion. So on the fiscal side, US public debt has gone up from 13.6 trillion in 2007 to 36 trillion currently. So during this period, US debt to GDP ratio has gone up from 64% to 121%. So the new US administration is likely to tighten its fiscal belt over the next few years, which could force the Fed to halt its balance sheet reduction. Both these will have major implications for US and global financial markets. In addition, the next few months are likely to be disruptive from a trade and geopolitical point of view, as well as given the efforts by the US to renegotiate its trade relations with the rest of the world. Chinese imports to US have already been slapped with a 120% tariffs, which again changes day by day and could go up further. Risk appetite is likely to remain jittery as markets try to assess the impact of potential changes in trade tariffs on different sectors and on different countries. Global value chains built up since China's entry into WTO and some even older could see significant disruptions over the next few months and hopefully not over the next few years. Which country will come out of this disruptive period as a beneficiary and which one will lose out could have a major impact on the flow of capital over the next decade. Coming to rapid changes in the technology landscape, in the last 10 years, the pace of technological changes has picked up and we have started to see major disruptions due to this. In the last few years, rapid development of EVs has seen China become a major automotive manufacturer, threatening the survival of companies that have dominated the auto industry for nearly 100 years. For the financial industry, algorithmic and high-frequency trading has changed the dynamics in many markets. Digital payments and now CBDCs are the other areas where technological developments have impacted finance and banking. But what is coming could be even more disruptive. The rapid developments in artificial intelligence in the last few years has given us a glimpse, especially since the launch of LLMs, or rather the launch of GPT-3 in June 2020, the focus and the investments in AI have seen an exponential rise. Products using AI are now all around us in our mobile phones, in our computers, and even in our cars and refrigerators. AI is already disrupting the industries like software development, coding, design, education, and healthcare, and there is no telling which industries and which jobs can get disrupted by the next generation of AI models. In the last few days, we have had announcements by at least 3 technological companies launching their quantum chips. The race towards quantum computing has reached its final stages, and it could just be a matter of years before we start seeing commercial launches of computers, each of which are more powerful than all of the computers currently in use. This is likely to impact nearly every sector of the economy and could lead to massive upheaval. Lastly, the navigating the uncertainty volatility. Normally we call it as a VUCA world, volatility, uncertainty, complexity, ambiguity. Now you add one more letter, Trump factor. So as investors and traders, these changes have real consequences for our economies and our markets. A lot of effort rightly goes into analyzing the possible impact of these changes and uncertainties. Hundreds of newspaper articles and reports have attempted to decipher the potential impact of tariffs on countries, sectors, and asset classes. Similarly, the possible impact of AI has been discussed and written about a lot. But how do you analyze what will be the impact of tariffs when you don't know which sector and which country will have tariffs imposed on them, and even the level of final tariffs is uncertain? Similarly, not many could have imagined that one of the big early successes of AI will come in the form of generating art or music. Therefore, most such impact analysis relies on the probabilities and assumptions. Often the decision makers are only interested in the final number and not the assumptions and probabilities involved. But we need to be careful to not assume the results of such analysis as the gospel truth. Using these results in our planning and risk management needs, to account for the failure of the underlying assumptions and consider the full range of probabilities. Derivatives should be used to hedge against extreme scenarios and diversification to account for the unsystematic risk. Stop losses and other risk limits have been developed to counter such risks and must be scrupulously adhered to, especially in the times of uncertainty. Finally, even as Forex dealers, it's important to remain abreast of the rapid changes in various fields so that we are not caught by the surprise. FEDAI's role as a SRO is crucial in enforcing compliance, setting industry standards, and ensuring best practices to ensure that Indian Forex markets can deal with all uncertainties. Thank you. Thank you all, and have a fruitful day.
Thank you very much, sir. Thanks for taking us through that journey from VUCA to VUCAT. That I find that term quite interesting now. So, may I request our FEDAI Additional Vice Chair, Mr. Ashish, to please hand over a memento to Sri Amara Rao, sir, as a token of our appreciation and respect for him. Thank you very much. Thanks a lot, ladies and gentlemen. With these enriching presentations and the speeches, now we come to the end of first part of our inaugural session of the conference. Now, moving on to the second part, where we have lined up 2 panels of discussions to deliberate on topics of relevance. And for that, I'm very happy to have with us today Shri Radhasam Rath, Executive Director, Reserve Bank of India. Shri Rath has over 33 years of experience with RBI, currently in charge of Financial Markets Operations Department, Financial Markets Regulations Department, and Secretaries Department overseeing RBI's financial markets operations regulations in forex, money and bond market, and also providing assistance to Central Board of Directors. Shri Rath represents RBI on Market Committee of the Bank of International Settlement, Basel. He also chaired the interdepartmental group constituted by RBI on internationalization of rupee, and is also the chairperson of the working group set up recently by RBI to undertake comprehensive review of trading and settlement timings of markets regulated by RBI. Shri Rath has an excellent career path, gaining experiences across markets, and he has also got published papers in the areas of global and euro crisis, forex reserves, central banking, and I don't think we could have thought of or got any better person to make opening remarks and to set the tone for the panel discussions which we have lined up today. I'm very happy to invite Shri Radhasam Rath to make the opening remarks, and please set the tone for the panel discussions for the day.
Have a glass of water. A glass of water.
Yes.
Or maybe a book or something. Can I lower this a bit? Good afternoon. Sri Rajeshwar Rao, Deputy Governor, Reserve Bank of India, Sri Ramon Rao Amara, Managing Director, SBI, Sri Samir Sayani, Chairman, FEDAI, Sri Aswini Sindhwani, CEO, FEDAI, distinguished panelists, delegates, ladies and gentlemen. At the outset, it gives me great pleasure to be amidst you here today at the 19th Annual Conference of FEDAI. I thank the organizers for inviting me. The annual conferences of FEDAI provide an excellent opportunity for the exchange of ideas among the forex market participants, and I'm sure this year will be no different. The organizers have requested me to share my thoughts on the panel discussion topics. However, I see that the panelists are eminent market practitioners in their own rights, and therefore, there may not be much more for me to say. While I'll share my thoughts on the 2 topics, let me first focus on something that we in the financial markets are grappling day in, day out, and which is aptly reflected in the theme of this year's conference, namely evolving paradigms in India's financial markets, navigating volatility, uncertainty in emerging new world order. One question looms large. What is the buzzword in the financial markets these days? The answer resoundingly is volatility, which is one of the themes here. Please allow me to illustrate this with a few striking examples. On March 5th, 2025, Germany's 10-year yield experienced its largest single-day rise since the fall of the Berlin Wall and the subsequent reunification of Germany in 1990. It was a seismic shift that reverberated through global bond markets. Meanwhile, Bitcoin, that has seen a meteoric rise since the US presidential election, has fallen equally sharply. And beyond the specifics, we are witnessing the world order itself in a state of flux. The world order is again part of the theme of the conference. Caught between the world order and beyond the specifics, we are witnessing the world order itself in a state of flux, caught between emerging powers and established norms. There are certain things that we know about the emerging world order with a reasonable degree of certainty, that a multipolar world is taking shape and that demographics will have a major influence on economic trajectories. Then there are those dimensions where the outcome is very uncertain. For example, the race in frontier technologies, the scramble for critical raw materials, and the unpredictable ways in which climate change will reshape nations and markets. Together, these forces brew what I would call unconventional volatility. Volatility is part of the theme. I would prefer to call it, I would prefer to go beyond it into unconventional volatility. This unconventional volatility manifests itself in multiple forms. We see volatility in economic data and volatility in the way the same data is interpreted. Just bear with me. I'll tell you, something which came by way of how data can be interpreted in various ways depending on the circumstances. Okay, and I just need to take that out. Just give me 1 second, please. Yeah, there it is. See, what I said is unconventional volatility, which manifests itself in multiple forms. We see volatility in economic data, more so volatility in the way the same data is interpreted. So, I believe on Wednesday, the US CPI number came soft, right? And this is I'm reading out from the Kobisi letter, current market mentality. CPI inflation lower than expected, sell stocks. We are entering a recession. CPI inflation higher than expected, sell stocks. Rate cuts are cancelled. CPI inflation as expected, sell stocks. Inflation is not falling. So there you have it. And the last sentence is sentiment is incredibly powerful. Now this is something again which, I had already written here somewhere in the speech. Let me see where it is. There's also volatility in narratives, shifting stories that drive market behavior. Perhaps the most powerful seems to be volatility in market sentiment. What he says, sentiment is incredibly powerful. Incredibly powerful, we all know. We have seen it for, decades. What is unnerving is the way sentiment today is volatile. The most powerful of all these unconventional volatilities, volatility in economic data, volatility in the way that same data is interpreted, volatility in narratives, shifting stories that drive market behavior. And perhaps the most powerful seems to be volatility in market sentiment, what psychologists might call mood swings. Together, these elements form the genesis of uncertainty. For years, we in the financial market have honed our focus on risk and risk management, fully aware of the subtle yet profound difference between risk and uncertainty. Risk can be measured, modeled, and mitigated. Uncertainty, however, is a wilder beast, and its proportion in our world seems to have grown exponentially. The single most significant driver of this shift has been geopolitical developments. That's basically the way the world order is unfolding before our eyes, often in ways we could scarcely predict. This uncertainty, again, something which is part of the theme of the conference. This uncertainty has polarized markets. We see it in the so-called Magnificent Seven in the US equity market, a handful of stocks where excesses have become commonplace. It's clear that these stocks would not reach such stratospheric levels unless investors buy relentlessly. But let's ponder over the reasons for unbridled investor optimism towards the Magnificent Seven. One plausible reason, may be the belief that technology is capable of everything. It's written here in caps, everything in near future. The belief that technology is capable of everything in near future. Tesla, for example, or whatever, AI. While out-of-the-box thinking is welcome, perhaps it should not be out of the planet or out of the universe. What about the proposition that man can settle on Mars? History offers us both wisdom and warnings here. As French writer Jean-Baptiste Alphonse Carr observed in 1849, the more things change, the more they stay the same. Karl Marx put it more dramatically. History repeats itself, first as tragedy, second as farce. Winston Churchill, with his characteristic foresight, urged us, the further backward you can look, the farther forward you are likely to see. In the context of financial markets, Carmen Reinhardt and Kenneth Rogoff, in their classic book, This Time is Different, 8 Centuries of Financial Folly, remind us that crises often follow familiar patterns. So where does this leave us? Volatility and uncertainty may define our present, but they need not dictate our future. The challenge before us is to adapt, to build systems and strategies that are resilient, yet flexible, grounded in history, yet forward-looking. We must learn from the cycles of folly and farce, harnessing the lessons of the past to illuminate the path ahead. This requires collaboration, innovation, and a willingness to confront both the known and the unknown with clarity and courage. To sum up, my thoughts on the theme of the conference, especially how to navigate the present times, are more or less. A new world order is emerging, but its contours are far from clear. Volatility is higher, more so uncertainty. We need to look through both. We need to concentrate on the medium term and long term rather than on the short term, and that the medium term and the long term should be truly so. Today in financial markets, medium term seems to be 1 day long, and long term 7 days at best. All of us together need to restore the medium term to perhaps a month or a few months, and the long term to at least 1 year. Okay, now let me turn to Indian financial markets, some recent notable trends. Over the last few years, there have been many significant changes in the domestic FX markets as the markets have responded to changes in regulation, trends in exchange rates, global headwinds and tailwinds, new participants, and developments in forex market infrastructures. Some of these things have already been said, but anyway, better to repeat it. The average daily turnover of the domestic forex market, including spot and swaps, has increased from $31 billion in 2020 to $47 billion in 2024. There are some interesting trends underlying the increasing volumes. For one, the growth has been higher in the interbank segment than in the client segment, suggesting more active participation by banks. The largest increase has been in the spot segment. One reason for the increase could be greater non-resident participation in the domestic markets. During the last few years, there have been periods of large FPI inflows as well as outflows. Both have contributed to increased volumes in the cash segment of the market. Another reason could be increasing volumes of international trade along with growing LRS flows as well as increased remittances. There has also been a discernible increase in NDF trades undertaken by domestic market participants. From June 1st, 2020, when such trades were first permitted, daily volumes have increased to about $7 billion in the recent period. These are almost entirely interbank trades. As our banks have started to participate in the offshore markets, the segmentation between onshore and offshore markets has weakened, as reflected in the narrowing of spreads between the two markets. In the derivative segment, while volumes have not risen significantly, the number of clients registered with CCIL Trade Repository for Forex derivatives has nearly doubled from about 43,000 in 2019 to about 87,000, suggesting more broad-based participation by users. In January 2020, banks in India were permitted to deal in FX beyond onshore market hours, effectively making forex dealing possible on a 24/5 basis. While volumes are not very significant, we do see banks making use of this facility to transact in forex market, both with the start of onshore market hours, reportedly to facilitate T+1 equity settlements, and post-market hours, possibly to capture a larger part of global market movements. Most of the trading pre- and post-market hours, however, appears to be confined to the period immediately before the opening of the market and immediately after market closing. There have been several developments on the market infrastructure front as well. In February 2025, CCIL started accepting interbank forex forwards transactions with tenor up to 36 months for guaranteed settlement. Before this, forex forward transactions up to 13 months were centrally cleared and settled. With this, over 99% of forex forward trades are now centrally cleared. Approvals under RBI's electronic trading platform directions were granted to 2 ETP operators for facilitating trading in reference rate or spot fix trades. Electronic trading facilities have since commenced for such trades on FX Clear. There has been an increasing trend in reference rate transactions being traded on the ETP in recent months. Trading on ETPs adds transparency and market efficiency. As such, we would like to see more and more of these trades being traded on ETPs. CCIL is now working on developing an electronic trading platform for forex options. I understand the platform is being designed to provide facilities for trading in various products, both plain vanilla options as well as commonly used structures such as spreads and risk reversals. CCIL is also parallelly working on putting in place facilities for central clearing of FX option trades. Both these facilities are expected to enhance the existing forex market infrastructure and add to efficiency in trading and settlement of the growing forex option market in the country. In February 25, reporting of all cash, term and spot interbank transactions to the trade repository commenced. Reporting of cash, term and spot client transactions will also start shortly. The availability of such granular trade-by-trade data is expected to considerably enhance transparency in the market and help formulate policy decisions. Overall, forex markets remain deep and liquid with narrow bid-ask spreads. Pricing and transparency for the smaller customers, however, remain a concern. Efforts by banks to create awareness and facilitate onboarding and transacting by customers to participate on the FX retail platform remain far from satisfactory. Amidst these developments, it's quite timely that we have embarked upon the goal of internationalization of the Indian rupee. As such, one of the notable recommendations suggested by the Interdepartmental Group of Reserve Bank of India that gave us the report on internationalization of the Indian rupee is regarding measures aimed to strengthen financial markets. Both the topics for panel discussion are quite interesting and relevant in this context, and I'm eager to get valuable insights from the deliberations. Please allow me to share my views on both the topics. I'll start with the topic for the first panel discussion, which is integration of offshore and onshore INR markets and unified price discovery experience so far and challenges ahead. Efficient and transparent price discovery is one of the basic functions of financial markets. Inefficiencies in the market can affect the price discovery process and in turn the price itself. A segmented market can potentially create such inefficiencies. A suboptimal price discovery process is not desirable in any market, much less in the forex market, as the exchange rate is one of the most important economic variables. The Reserve Bank has been guided by the objective of developing a deep and liquid forex market. As in the case of many other currencies, there is a sizable, non-deliverable offshore forex market for the rupee, and volumes in this market have been growing swiftly in the recent past. While the onshore and offshore market for the rupee have displayed bidirectional price linkages, the two markets remained segmented with price differentials persisting. Such segmentation has the potential to impair price discovery and exacerbate volatilities and also potentially impair the effectiveness of policy objectives in this sphere. Therefore, the Reserve Bank has been taking several measures to integrate the offshore and onshore markets for rupee to ensure unified price discovery, with the onshore market serving as the locus of price discovery. AD Cat 1 banks in India, which operate IFSC banking units, were permitted to offer non-deliverable derivatives contract, NDDCs, involving the rupee to non-residents in 2020. Such contracts can be offered to non-residents without any restriction in terms of purpose and can be settled in any foreign currency. Banks have been allowed to offer prices to their non-resident clients on a 24/5 basis out of their books in India to enable them to service the needs of non-residents in their own time, zones, and geographies. Banks can deal with the non-resident clients from the Indian branches or on a back-to-back basis through overseas entities. In addition, exchanges in GIFT City have also been permitted to offer dollar-settled rupee derivatives. More recently, resident users have also been permitted to transact in NDTCs. 24 Indian banks have been participating in the INR NDF market since 2020, when they were first allowed to transact in these markets. The daily turnover of these banks has steadily increased since then to about $7 billion in the recent period. Also, the participation of Indian banks in the NDF market appears to have positively impacted the price differential between offshore and onshore rates, as indicated by the compression of the spread between the offshore NDF and onshore deliverable forward market. Similar to growth in offshore NDF markets, an active market for rupee interest rate swaps has been growing offshore, with the most popular instrument being the non-deliverable OIS. Similar to onshore Mumbai, onshore MIBOR, reference to OIS contracts. Recognizing that this has effectively segmented the rupee interest rate swap market between the onshore and the offshore markets, impeding efficient price discovery, and also to develop a deeper onshore market, non-residents were permitted to access the onshore interest rate derivative market in 2019. Post this, the participation of non-residents has increased in the onshore markets, and the segmentation between onshore and offshore market has reduced. The average spread between onshore MIBOR OIS rates and ND OIS rates has fallen from a range of 7 to 12 basis points to 1 to 2 basis points in recent times. To provide a further fillip to the interest rate derivative market in the country and improve the efficiency of price discovery, banks in India have been recently permitted to undertake transactions in offshore FCOIS, foreign currency settled overnight index swaps market with non-residents and other market makers. Importantly, an onshore interbank market in non-deliverable derivatives is emerging, wherein local banks transact with each other. Market integration is a continuous process. Effective integration can be realized when the onshore market is robust and well developed, and all challenges and roadblocks in its integration with the offshore market are overcome. In addition to the specific regulatory measures relating to integration of the onshore and offshore markets stated earlier, the Reserve Bank has taken several steps to ensure robustness of the onshore market infrastructure. A regulatory framework for electronic trading platforms was introduced in 2018. Legal entity identifier was mandated for OTC derivatives in 2017, and transactions in non-derivative markets, and for transactions in non-derivative markets in 2018. Directions for financial benchmark administrators were issued in 2019 and reviewed in 2023, and a framework for SROs in financial markets was notified in 2024. Stipulation on variation margin for non-centrally cleared derivatives were issued in 2022, and those for initial margin were added in 2024. To augment the Reserve Bank's visibility over the forex market, reporting of forex cash, TOM, spot deals to the trade repository in a phased manner, in addition to the existing mandate for reporting OTC derivatives transactions, were issued in 2024. These apart, specific directions relating to market integrity and conduct of market makers, namely directions for prevention of market abuse and conduct guidelines for market makers in OTC derivatives, were issued in 2019 and 2021 respectively. While the aforesaid regulatory measures have aided in strengthening the market infrastructure, some challenges to integration remain. It's observed that banks in India are dealing primarily with global banks and market makers in offshore markets and are yet to emerge as market makers to offshore clients. We also need to increase the electronification of the onshore forex derivatives market to improve trading efficiency and transparency in the price discovery process. Coming to the second panel, which is evolving role on SRO in changing regulatory landscape. SROs help to enhance the effectiveness of regulations by drawing upon the technical expertise of practitioners and aid in framing and fine-tuning of regulatory policies. The role of self-regulation and its presence differs across countries and market segments, as well as across the developed and emerging markets. A significant role for SROs emerges from consistent responsible behavior over a period under the supervision of the regulator. A healthy relationship with the regulator enables SROs to contribute towards effective regulation in the interest of market participants. There are various types of self-regulation prevalent in financial markets, such as industry self-regulatory organizations, exchange self-regulatory frameworks, and private associations that define and encourage adherence to standards of best practice among members. In our markets, FEDAI and FIMDA have been functioning as SROs in many ways, though these entities are not formally recognized as SROs. Globally, however, SROs in the financial sector have been recognized with the objective to delegate authority, frame guidelines for appropriate conduct by its members, and utilize tools such as agreements, standards, charters, bylaws, handbooks of market practices, etc., to ensure appropriate conduct. While the growth of the regulatory entities, with the growth of the regulated entities in terms of number as well as scale of operations, increase in adoption of innovative technologies and enhanced customer outreach, a need was felt to develop better industry standards for self-regulation in the financial markets in India with a more formal footing. With this in mind, the Reserve Bank issued the framework for recognition of SROs in financial markets in August 2024. The framework sets out the broad objectives, functions, eligibility criteria, governance, standards, etc. for SROs and is aimed at complementing the extant regulatory framework and further develop the financial markets. I hope that FEDAI and FIMDA become more effective than ever before as they strive towards formal recognition as SROs. What's the way forward? To conclude, FEDAI has been instrumental in conceptualizing operational guidelines on the conduct of foreign exchange business among banks and the customers and has contributed to customer protection and fair treatment. It has effectively acted as a bridge between the market participants and the regulator and has contributed to the development of the foreign exchange market in the country over the years. Going forward, I expect FEDAI to play a more effective role in terms of enhancing professionalism, compliance, innovation, and ethical conduct in the forex market. FEDAI is also expected to promote adoption of best practices to ensure transparency and fair pricing for retail and small participants while accessing the forex markets. I wish the two panels very rich deliberations. I once again thank the organizers for giving me this opportunity to address the thought leaders in the forex market. Thank you and namaskar.
So Srinivas to please hand over a memento as a token of our respect and appreciation for sir. Thank you very much, sir, for introducing us to the different ways of interpreting data, not just the volatility in markets, but also the volatility in narratives. And I think what we feel very often is also the volatility in sensitivities and the overall market expectations as well. Now, thank you, sir, for setting the tone for the discussions today. And to start the panel discussion, I would like to invite Shri Samir Sahni, Chairman, FEDAI, Chief General Manager, Global Market, State Bank of India, who is also moderating the discussions. And for that, I'll invite him to the dais. And just as a brief introduction, I would like to tell, I think, though the most of the market participants would be knowing that Mr. Sahni is overseeing the treasury operations of the largest bank, State Bank of India, consisting of investment portfolios, money market, equity, and private equity of the bank and the forex market with a combined portfolio of nearly 15 lakh crores. I think I'm right. The number might have increased in the last few days. And prior to this current assignment, Sri Sahni was General Manager Rupee Market of the Treasury Operations. And under his guidance as Chairman FEDAI, I have already shared with you some of the developments he also narrated. We are very happy to have you here, sir, today. And maybe with him around, I won't like to dare to introduce his panel members. I leave and request him to invite the panel members and also to introduce all the panel members, sir.
Good afternoon to all of you. Once again, I'm back, and Mr. Sindhwani keeps on giving me more responsibilities, though it's thanks to him that I am here. So without making much of a delay, I would like to invite my fellow panelists. I would like to invite Madam Dimple Bhandia, CGM FMRD. Madam is heading the Financial Markets Regulation Department. RBI, ma'am, please take your seat. Her tenure has seen so many regulations coming in which she has brought about, and we were talking about NDF. This is a regulation which came during her tenure. A lot of regulations, we just finished compliance with one of the regulations, a new one comes. So you have kept us busy, starting from COVID. When everybody was working from home, that time this department was working overtime, really. So ma'am, I don't think anybody needs more introduction about you. I would also like to invite Mr. B. Prasanna. He is Group Head of Global Markets, Sales, Trading and Research, ICICI Bank. Again, a well-known personality in his own right. Sir, please. It's a very powerful kind of a panel. You want to be away from ma'am? That's okay, fine. But somebody will have to sit next to him. And the third one, Mr. Vijay Parthasarthi, Managing Director and Head Institutional Sales, Citibank. So we have a very powerful panel over here. The only thing which I would like to say, most of my preparation for opening remarks has already been covered by Raj sir. So with this, because I wanted to give why we were permitted to do, so instead of doing that, I have just deleted all from my memory. I would start with what is my interaction with NDF and why I am very deeply connected to NDF. Since 2012 to 2016, and that included the period of taper tantrums, which is now historical, I was head of State Bank of India's treasury operations in US. And as the timing difference goes, we were just permitted to do one activity, that is to sell Indian rupees to whoever wants to buy. And at that time it was my dream, rather a wish inside, we can't say it outside, but inside, that can Indian banks one day be, or will I be one day permitted to trade in NDFs? Because NDF now becoming, with the increased globalization, it is but natural that currency had to become international. And emerging market, with the increase, the data was already shared today in one of the earlier, that they had to become the kind of internationalized currencies, including emerging market. So there was to be a time. And then finally, from 1st June 2020, NDF was permitted to us. So this step which was taken by RBI, of course ma'am was there, which allowed the Indian domestic banks to also participate in the NDF market, as well as later on the regulations were further, the fillip was given so that domestic entities also could participate in NDTFs. So ma'am, my first question to you would be, I would like to understand from you the RBI's perspective and vision at the time of introduction, or rather allowing Indian banks, those banks which have a presence in GIFT City, those having GIFT City IBUs, to permit them to trade in this, ma'am.
Thank you. Actually, I don't know what to say. I think sir has spoken, you have spoken. Very much what my ED mentioned, what Samir sir mentioned, if all of you have been in markets, you have to look at a package. You know, it's 1 rupee traded in different venues of the world, but it's the same rupee. It should not logically, economically, in efficiency terms, have different prices. And that is what was there, one. Secondly, while the rupee was moving in value, you had a IT company here with exposure, you had a oil importing company with exposure, you had anyone with an exposure not able to hedge. Whereas the rest of the world, which had a rupee exposure, could hedge. I'm not even going down the line of taking a view. They could hedge. We had gap up, very large gap up openings and openings in the market. You never knew when you went to bed, literally and figuratively, what is the value of the rupee you would end up with. We were far away from the law of one price. So I think it was this that was in mind to put things together, have a single market for the rupee, give everybody an opportunity to participate just like anyone else. So there were two simultaneous announcements, one in January 2020, which said banks could offer rupee trades beyond trading hours, and then the one in March, which came into effect, that banks could also participate in the NDF market. I think if you put these two things together, this is broadly what was there in our mind. And let me add a third one. There are some of you who are branches of foreign banks. There are some of you here who are Indian banks. I'm sure if I were in the dealing room, I would be very unhappy if my counterparts overseas could deal in the NDF market and I couldn't. I've been a dealer myself, so perhaps this was the third part of it.
Ma'am, just a follow-on question. Now, after 5 years, almost 5 years, has that vision been realized, in your opinion?
So I think two parts. As far as making it one price, if not a very close price, yes, that has been realized. What I'm less happy, at least personally, and I think I speak for my institution, is we haven't seen trades really move onshore. A large part of the volumes in the NDF market have been banks trading with each other, banks trading with market makers overseas. It's been true for foreign banks, it's been true for the Indian banks who are dealing with it. I would say the agenda would be complete when we see a much larger volumes of global client trades, end user trades also coming here. We haven't seen that. We haven't seen that absolutely, practically nothing of that we have seen. So all of you are here, I think much more aggressive. Remember, and if I may add, what I see banks in India doing right now in the NDF market is basically arbitrage. So there's a difference in price, you arbitrage it away. I've seen one or two banks, one of them is sitting here on the dais with me where I have seen client trades from, and that's extremely heartening. Remember, when more and more banks participate, the arbitrage goes away. What is actually left for the market makers as a whole to actually trade and make money from is the client trades. And I think I would like to see much more of client trades in the NDF market, see much more of Indian banks emerging as market makers globally, rather than just as liquidity providers and arbitrage profiters. I think that is very much work in progress.
Thank you, ma'am. The message is very loud and clear for all the traders sitting here, and I'm sure they will take up the challenge. Just on that, I'll like to address Mr. Prasanna. What has been your experience and learnings for one of the major Indian banks in terms of participating with non-residents in the onshore OIS and NDF markets, and how it has helped the Indian end users?
So I think, sir, first of all, when the regulator sits in the stadium, in the stage and talks, we should listen and we should accept.
So I have to say, he is not here, but Mr. Jena and Prasanna being there, I know my legs are going to get pulled every single time.
No, but anyway, sir, to answer your question, I think if you look at the markets, half as traders and half as people who generate client trades. I would say that for all the FX traders sitting here, it's literally been a liberating experience. There have been times, I know, when you go home, like ma'am was saying, without knowing what the gapping risk is going to be, and the next day morning you're exposed to, you look at the offshore trades and then you figure out where the market is going to open. But at this point of time, we were actually able to, participate in that market. So for the set of traders, it's a wonderful, liberating experience. And the frustration of not being able to participate in a market which is trading, which is your own currency, which you're not able to participate, is now gone, largely gone. But I have to agree when she says that are Indian banks really participating in this market on behalf of clients, or are they just trading and doing interbank market making with other banks who then are doing the trades with clients offshore? I would have to agree with that. So I guess there is a truth in that as well, and I think Mr. Ravi Shankar also spoke about that very recently. So our endeavor as part of our own bank has been to try and improve this kind of client positioning and client marketing as much as possible. But if you really look at it, sir, I mean, every market has hedgers who have underlying positions, but they're not able to have access to onshore, so they trade offshore. Then you have speculators who want to trade dollar INR through offshore mechanisms, and you have arbitrages as well. And there are 5 or 6 very clear reasons why the non-residents were not able to access onshore seamlessly. It includes documentation, it includes product suite, it includes timing, it includes even the kind of flexibility to cancel and rebook and so on and so forth. Now, like you rightly said, between March 2020 and somewhere around June 2021, so many guidelines have come which has now made sure that most of these drawbacks are not there anymore. So I think today we don't have, as market participant, any excuse in not, doing trades with non-residents, whether it's offshore or onshore. There are 2 curves available now, and like ma'am said, it's come down. The pricing difference has come down a lot, but there is still some marginal prices do exist. So in terms of our experience, I can maybe say just one thing and then, stop at that. When you have 2 different demand supply going on, you have a non-resident demand supply, then you have a resident offshore, onshore demand supply. And obviously because of arbitrages, the prices have evened out a lot. There used to be 70, 80 paisa difference between onshore and offshore at one point of time. Now, even if you get 7 or 8 paisa, you're very lucky. It's normally very much lesser than that. And in NDOIS, in OIS itself, it's just less than a basis point. But there are times when, because the rupee in the offshore market is more volatile than the onshore market, and one of the reasons, of course, being the presence of a regulator like RBI in the onshore market, there is much less volatility. I'm sure a lot of us will agree, and much more volatility offshore. So you have much more volatility in the underlying market, because of which the implied vols in the offshore options are much higher. So a corporate today in India is actually able to, by virtue of the fact that the regulations now allow him to participate in that curve as well, is able to construct a profile, a risk profile, at a much cheaper cost than what he could have done onshore. So I think that is a direct benefit for a corporate, and also now with Indian banks able to, offer that corporate the offshore curve as well, it's a really truly liberating experience. So I think that's where I will stop for this, and then maybe but there are a lot of challenges on the monetary policy and all kind of things that RBI has to go through. Maybe if we have time, we can discuss that later.
Yeah. For once, I am very glad that I'm the moderator over here, and you had to answer this question. Otherwise, same question would have been difficult for me. So I'll move to Vijay now. Vijay, given the increasing participation in non-deliverable swaps and non-deliverable options, do you see any risk of these offshore instruments impacting the onshore forward and derivatives markets?
Okay, firstly, I would like to start off by saying that ED sir said that there is volatility in data interpretation. One thing we're all thankful, with respect to regulatory reforms, there's no volatility. I think we set out on a journey a few years back, from a prescriptive to a principle-based approach. And what you've seen now is the markets have largely integrated to an extent where, in the morning, traders will look at where offshore is quoting and then, start off where the onshore will start off pricing. But today the roles have actually reversed, where onshore sets the tone for the offshore market, and they actually start becoming much more active only when rupee market starts locally. With integration, volatility will move through, but it's not just, I would say, one-sided, it's actually both-sided. Obviously, the larger offshore market community, which kind of induces volatility and thrives on volatility, is the fast money clients, and they would trade, crosses, they would trade relative value trades, digitals and barriers, which will automatically pass on to the onshore market because of the high level of integration that we have seen today. At the same time, it also moves in the reverse direction, which is in terms of, especially on the rupee rates market, where local corporates, etc., have started using the long tenor derivatives space. This kind of moves offshore. Market events like FX swaps, auctions, etc., which are more only possible in the domestic market, also has implications on the other side. Now, risk will continue to be there in the market. I think the key is the integration. And on the margin, if you look at it, given the two liquidity pools all broadly converge, It means any kind of event that we face from a domestic perspective or from an international perspective as far as INR is concerned, it just evens out given the two pools that are available.
Thank you, Vijay. Ma'am, I'm coming back to you and with a slightly difficult question this time probably. While the decision made by RBI to allow domestic banks to participate in NDF market has enhanced liquidity and price discovery, but do you foresee or does the regulator foresee any risks or challenges in terms of market stability regarding the participation of domestic banks in offshore market? And if yes, then how do we plan to mitigate those?
Let me start off with an anecdote which is got nothing to do with markets. I had a professor, I was an economics student, and I had a professor in Presidency College, Calcutta. His name was Dr. Deepak Banerjee. He incidentally is the father of Abhijit Banerjee, who a couple of years back got a Nobel Prize. I'm sure many of you know the name of Abhijit, at least knew him. Mr. Banerjee, Professor Banerjee was one of those most outstanding professors, extremely sarcastic sense of humor. So I had a colleague who used to be absolutely scared of Professor Banerjee and would always try to find the tallest or the widest student in the class to sit behind. So one day, Deepak Babu, as we call him, he used to teach us microeconomics, and he stopped and he walked forward, went and stood next to this student who was trying to hide and said, "You know what an ostrich is?" And we were all flabbergasted. So he said that the ostrich buries its head in the sand and it thinks that if it cannot see anybody, nobody can see it. So I think to a large extent this was it. The markets were there. Whether we take cognizance, whether we allow our banks to participate, the risks were coming. As Vijay mentioned, it was a one-way risk, now it's become two-way risk. So I don't see any additional risk as such from banks participating. We have a prudential regulatory framework in place. No limits are there. Nobody goes beyond the no limits. There's a market risk, there are capital limits, etc. We have, I think, tried to put in place very well-defined limits for market making, for, now variation margin has come in place and initial margin will start. So I don't see the counterparty, whether it is domestic or whether it is, it's an overseas counterparty, really adding to risks. On a macro basis, volatility, I think the risks which are there continue to be there. I just have a feeling that by removing the segmentation, we actually manage them better. Or we give banks the ability to manage their own risks better, and I think at a macro level also risks are getting managed better. So just by way of banks participating in offshore market, by itself, I don't see any additional risks. I think sufficient prudential, regulatory and surveillance tools are in place. I'm sure many of you very often have got a call from my surveillance team to ask why, what is happening and what is the reason for that. I think they're enough. I don't see any specific additional risk out of our banks participating in the offshore market as such.
Thank you, ma'am. That's very comforting to hear. That's very, I think, so that means the activity of Indian banks also has increased and they have reached a level whereby the confidence of the regulators is with them. So that's good. Coming back to Prasanna ji, the integration of offshore inshore and the domestic market, offshore and onshore market has happened now for 5 years over a period of the interest rate cycle. What do you see the policy ramifications of all that?
So I think ma'am was talking about there being very less risks in Indian banks participating. I do agree with her on the market side, but somewhere I feel that on the policy making side, there is some repercussions which have happened. Let me try and explain that. So there are three ways, I think, or three methods by which the Reserve Bank or any central bank for that matter can intervene in currency. So let's assume that there is no NDF and Reserve Bank intervenes in the onshore market. The repercussion on liquidity is clear and known, so they have to have a solution ready for what they want to do on liquidity. Suppose they are doing it on NDF. NDF is actually just a bet on the currency, and it's quite possible that RBI does what it wants to do in the NDF market, influences the price there, but just closes that bet by either receiving the profits or paying the losses and with no impact of liquidity in Indian markets. This is if Indian banks are not allowed to participate there. But now that Indian banks are allowed to participate in the NDF market, any action by the Reserve Bank on the NDF side, because Indian banks are actively arbitraging, also translates into a liquidity problem into the Indian market. So this is, according to me, is the only change or the only, should I say, repercussion of the fact that we have allowed Indian banks to participate. So nowhere am I saying that it's not a good move. I think it is a good move, and I think it is a necessary evil, and that's the way I think about it. And let me also explain different cycles you had asked in your question. So the interesting thing is, whatever, let's assume in a cycle where dollars are flowing into the country, RBI, buys those dollars, sells rupees, then it's giving liquidity into the system, but it doesn't want that liquidity, so it postpones it, and hence pays forward, but does a buy sell and pays forward. Forwards go up, and Indian banks find it very attractive because they can now sell dollar here and buy dollar abroad. So they are actually exacerbating the situation. That's when dollar comes in and when RBI is buying dollars. The same situation when dollar is going out and RBI is selling dollars, exactly ulta happens because they are now receiving forwards. So again, it becomes attractive for the Indian banks to do what the RBI is doing in the onshore market. So the problem for RBI is much more. So what it effectively means is, when dollars are coming in, the reserves of the Reserve Bank are going up by more than what the real money flows are in, because Indian banks are also arbitraging. And similarly, when dollars are going out, the reserves are falling much more than what the real money, investors are determining the. So I think the problem is there's an asymmetric problem. You don't mind reserves going up as much as you want, but you have a problem when reserves fall. So that is the reason why we have seen so much of activity over the last 2-3 months. This, according to me, is the only repercussion, but I think as an economy, as a institution, both the central banks as well as all of us in the markets need to be prepared for. We understand these risks, and we need to be a part of the system in order to undergo the kind of transition that's happening.
Yeah, thank you. You have put the risk clearly. But I believe the regulator, I'm not going to ask ma'am, but I believe the regulator is fully confident of meeting this additional risk, as well as the confidence in Indian banks' ability to support RBI. But coming to volatility and the things which can lead to it, Vijay, what can be the impact of US tariffs on USD-INR pair? Do we need to take any steps to reduce the impact on Indian FX market? And this is going to be a tricky one. Where do you see USD-INR in next 6 to 12 months time horizon, since foreign inflows have been lackluster in most of the emerging markets, including India?
Okay, firstly, obviously before the impact on dollar rupee, I think the uncertainty is largely on the tariffs in itself, right? So maybe let's spend some time from an Indian context, right? Because it's spoken so often. But purely from an India-US relationship, let's just take a step back and look at in terms of how do we quantify this. And our economics did a detailed note around the India-US relationships. I mean, clearly as a trading partner, US is super important. I think trade, we are like close to 18-20% of our trade goes to US, and services is much more. Contra on the US side, I think we are significantly lower from a trading partner from a US standpoint perspective. Tariffs in India in general in terms of percentage has been growing significantly. We used to be in the 6.5-7% region and moved to closer to 12-13% region. But a large amount of that is actually coming from tariffs on agri and agri related products that have happened. Now, obviously, the conversations with the two governments have continued over the course of the last 1-2 months. Some measures have already been taken as far as India is concerned. The bigger ones, obviously, which we want to look out for is in terms of changing the complete equation would be on the energy side and of course on the defense side. The number, of course, in terms of trade def is close to $45 billion odd, which US is earning against India, which is a number which has been growing significantly. I wouldn't say significantly, but at an increasing pace over the last many years. Now let's look at what are the options available from a US perspective, right? I mean, you assume the worst case and say, okay, what if the retro tariff is exactly equal to what India is applying, and then obviously it means a detailed analysis of, I think we did close to 1,200 goods and see how the tariffs are between these two countries. And even if you come to, let's say, an equal and retro tariff, the impact on the margin is close to $7 billion odd as far as the trade is concerned, which is close to 0.2, 0.25% of our GDP. I think the bigger impact, which is broadly going to be on the uncertainty of tariff and how it's going to affect globally, right? In terms of, how global trade balances kind of start shifting. And that could have a larger ramification onshore which is concerned, which is more in terms of supply side shocks, and that's the entire the private investment cycle. That for us is probably a larger worry as far as, on the tariff is concerned. Now, again, on the dollar rupee side, I think slightly, I would say much more factors kind of affected. We had put out a note of 89 on dollar rupee when dollar rupee was actually at 84. Few factors which we considered at that point of time. One, obviously, being the US exceptionalism. Second one, in terms of our own RER, which RBI measures. At that point of time, we were closer to the 107, 108 kind of levels. We also had to look at how China will react in terms of US tariffs. And lastly, our own BOP, because ultimately, I would say BOP change would probably be a reflection of the RBI reserve change also, and also in terms of where dollar rupee should trend overall. From there to now, I think few things have changed. From a US exceptionalism, now the conversations are increasingly moving to even decoupling. We've started actually flows starting to come to China in EM. As far as absolutely, if you actually look at how China has reacted, I mean, they have taken 20% tariffs, but they haven't really moved out as far as the currency is concerned. Our own currency in terms of RER valuation has now broadly come to around 80, 102, 103 levels, where we are today. The last one, which is quite slightly difficult to predict, is in terms of the EM flows on India in itself. After having a bad, Q3 and on the Q4 also, it's not starting off on a great note. The equity flows have been broadly negative, and they continue to be negative as far as India is concerned, which is a risk factor for us broadly. I think on the debt, we have continued to do well. Most people actually put out when the bond index inclusion actually came out, around $25 billion to $30 billion of flow to come in. We had 15 odd roughly last year, 5 already has come in, and if we have time till the next June, till the balance, the rebalancing actually happens, we'll probably reach the 25 billion number. With this in mind, I think, short term we feel March should be probably 87, 60, 70 as far as March end is concerned. But beyond that, the equity flows can be quite heavy, and that can actually push dollar rupee to closer to 89 again. And it's very difficult to kind of now give a 1 year kind of a view or a longer tenor view on dollar rupee, but I think these are broadly the risk factors market should watch out.
You said that equity flows may resume after March, or you said they will further
I think
strengthen?
the equity flows, again, one is
Inflows.
obviously in terms of valuation. When we speak to our global clients, right, when it comes to, I think the debt flows will continue. I think that is kind of sticky. There's a predictability pattern to it which will happen. Equity one, when we speak to our FPI clients, etc., well, it's still on the margin, I would say slightly negative only. Valuation conversations have actually started, and the recorrection has happened in terms of forward P, etc. I think what has been reassuring for them is two things. One is actually the GDP print, like bottoming out. There is expectation from the CUM, etc., in terms of the numbers panning out. The budget in itself, especially on the retail side, in terms of the tax reliefs that is given. So all in all, I think people are now starting to turn the tune into being slightly positive. Numbers are yet to show, but I think it's very difficult to predict as of now. We'll have to kind of wait and watch, but clearly this decoupling that we are seeing on US, that will have a positive benefit as far as India is concerned, because people are now starting to get slightly tired in terms of X in the morning, tariffs, Y in the evening, and then you start off another day. So you'll probably see that trend to continue for the time being.
So you mean to say the earnings will be the key. Thank you, Vijay. I'll change gears a little bit, go back to ma'am. Ma'am, what are your thoughts now on bringing in more efficiency in NDF market by having better and robust infrastructure for NDF trades, especially availability of anonymous platforms and more transparency in the markets?
I think that's more of a question for CCL here, but from our perspective, yes, I mean, it's a global move, but I think from our side, we are happier the more and more transactions go on trading platforms, go on central clearing. All of you would be aware now, recently CCL has moved FX forwards up to 36 months. I understand now, earlier it was 13 months, now up to 36 months are being centrally cleared. I understand that's about 99% of all the forwards. ED sir mentioned FX options, there's also a trading platform. I think CCL is also working towards an NDF thing. Let's see how it pans out. There aren't so many trades actually. It's few banks just trading with each other. One leg of the trade is outside the country with an offshore one. So to what extent it's going to be feasible, I think all of you can work with CCL. If it is feasible, I'm very sure. I mean, it'll definitely have a blessing if it adds efficiency to the whole thing. But there just has to be sufficient number of trades and sufficient participants for that to really work.
I think, ma'am, we have a CCL presentation after this panel, so somebody may ask or we may ask this question to them. Coming back to ICICI Bank and Prasanna ji, once again, with 5 years of experience, what is your estimate of India and Indian banks in offshore markets? Can we improve this, and what are the challenges you foresee?
So before I answer that question, sir, and since Vijay spoke at length about the view on the dollar rupee, and when Mr. Rammohan Rao was talking about Trump tariffs, he was talking about how can you do an analysis when you don't know what is he going to put a tariff on and how much is he going to put it and whether it's going to stay. And also when Mr. Ratho said about volatility in the sentiment itself and the volatility in interpreting data. So what I remember is an anecdote in my own boardroom. The joke is, whatever the question is asked, I give the answer, it's because of Trump tariff. So they asked first day, why are the bond yields up? I said, because Trump tariff will create more inflation, bond yields are going up. Then they asked, why are bond yields coming down? Then I said, Trump tariff, because the growth is going to take a hit, there will be interest rate cuts, so bond yields will fall. Then gold went up. So they asked why. I said Trump tariff. So it goes on and on. So now they ask the question and they say, yes, I know, President, it is Trump tariff. So that's the extent to which
let me make an observation. I believe you are the only person who is benefiting from Trump tactics.
Because we don't need to do the analysis. We just need to tell about him. But, sir, on the aspect of NDF and what can make it better, I think ma'am hit it in the nail in the beginning itself when she said that I think the observation is that Indian banks are broadly doing arbitrage. And so when Indian banks are arbitraging, it's not necessary, of course it is good, it is helping the price kind of get unified, but it is not necessarily the maximum to which a particular market can go. And the other thing about this arbitrage is that Indian banks predominantly, I'm saying, not everybody, I'm sure there will be other people as well, assume that you buy at a spread and hold it to maturity. At maturity, the spread will be zero, so you make money for sure. But then the point is, it is not a linear transition towards zero. There is a lot of volatility in the basis spread itself. So what that effectively means is that sentiments and the fundamentals also determine the kind of spread that exists on a daily basis. And the differential sentiment between global investors and Indian real money participants can always be different. So I think we should get into a little bit of market making on the spread itself. So it's the basis market making, and that will ensure that Indian banks can trade between themselves as well. Today, all the Indian banks are on one side. Either they, receive and make the arbitrage, or pay and make the arbitrage and hold it to maturity. Now, in between, if you are forcibly asked to exit your positions, which, the call can come anytime, then you are going to, lose out on that. So, in fact, ma'am, during those times, it's when we hope that our phones don't ring. But anyway. So that is a challenge, sir. And but in terms of the good things that have happened, like I said earlier, the spreads have come down a lot, and it's now very, very within manageable limits. And so that is something which is good. And I also noticed that a lot of volumes are happening predominantly in the up to 3-month maturities, and beyond 3 months is hardly anything. But then if you look at the global, experience, that seems to be the global experience as well. And the power of speculators in trading, speculators typically trade the shorter end, and it's the hedgers who trade, who take positions in the longer end. The power of speculators is a multiple of hedgers, so I think that process is also playing out in India as well. So I guess the process has started, it should go on. And while there are challenges like on the monetary policy side, while on challenges on how Indian banks manage clients' requirement, I think we need to, kind of get over it. There could be a lot of requirements like KYC. I mean, like our international clients, we do have offices in Singapore and Bahrain and Hong Kong. International investors, their clients, they always prefer to do their deals there rather than do it here, and clearly the KYC requirements are different. So I think these are some of the challenges that we might want to look at as we go forward.
As RBI has permitted domestic corporates, those who are eligible to trade in NDF, maybe that can also help if they pick up. So far those volumes are not too high. Coming to Vijay, and this is going to be a question which everybody would like to hear the answer to. What are the global banks? You are one of the global banks, one of the top 10 banks. What are the global clients' views and experiences around onshore dealing with the numerous regulatory enablers which have now been put in place?
I think let me start off by saying it's been immensely positive, especially because bulk of the clients are real money clients who would be accessing India. I mean, earlier it was challenging in terms of you can cancel and rebook up to only 1%, so everyone would be like putting on their spreadsheets how much they have cancelled, how much can rebook. I think we have come a long way from there. Now, if you have to broadly, let me just cut out the global clients into 3 parts. The first one is probably fast money. In terms of fast money clients, I think the key things that, they kind of hit a hurdle when it comes to dealing domestically. One is, I think, taxation. Many of them are actually Cayman registered. So when you kind of want to deal onshore with some of these clients, because there's no treaty, the withholding tax can be as high as 40%. So that's one hurdle that we see with fast money clients. Now, what is, I think what can happen and what is beginning to happen there is in terms of dealing with these clients from the IFSC branch, where the tax implications are actually broadly negated. The second one is the entire FX prime broking setup, which is there on offshore, which is not really there onshore. But LCH is actually an option. It kind of negates to some extent the taxation implication also. The KYC is all still there, but as more and more Indian banks actually participate in the LCH, where majority of these transactions are cleared, it will definitely make it easy for them. The second one is real money. I think increasingly they have started adopting, including many sponsor clients in terms of, whenever there's a big type of situation where they want to kind of hedge, I think now the conversations are clearly starting to become onshore, where they can actually do on anticipated exposure as well. The KYCs, etc., yes, it remains a challenge. So the starting point will obviously be your FPI clients, where, any which ways they've done the KYCs as far as, the locally to access the Indian bond or the equity markets to make it slightly easy. It is going to be a journey, in fact, and it's a very hot conversation with even all foreign banks in terms of, when we have a regional sales coming in terms of how do we kind of make India as a one-stop shop for both deliverable, non-deliverable, and access all the global clients sitting out of India. But it's going to be a slightly, I would say, it's a journey. It's not going to happen overnight, and most banks are, I would say, are up to it. The last one, I think, is banks, and I think there's been fantastic participation as banks have concerned. So while we want each of these clients to actually participate and come into the onshore market directly, I think banks have now taken it upon themselves to act as a bridge. Eventually, as we start unlocking each of these issues one by one, we will see a seamless movement from offshore to onshore. I don't think will it be ever 100%? No. But I think if we start getting in the high 70s to begin with, I think that'll be a good thing to achieve. And it's broadly upon us market participants to make that happen at this point.
Yeah, I believe, Vijay, you're right, but the conversation as well as the intent of the government and various regulatory bodies to ease the pain of KYC process. It's only the process. KYC is a known fact. All regulators across the globe would require it. So the only thing is maybe that process, if it can be streamlined, made more, maybe simpler or more painless, I think that's going to.
It happens, right? Because when the bond index inclusion happened, at least we had more than 800, 900 FPIs, each of them registering, and and it's also how the clients also react to some of these things. And over a period of time, they're actually now seeing that, yes, KYC is been a challenge, but if you have to access Indian markets, then you have to get over it. So you'll have to give some of these large global clients a bit of time. Especially if you see a number of sovereign wealth funds who have started accessing is increasingly increased. Broker dealers are participating. As I said, it's going to be a journey, and it's on us banks to explain to them to untie all the knots that are there with respect to the KYC process.
Right, so I believe the onus is on us to educate them and tell them what is one problem. Ma'am, coming back to you once again, what is your thought on NDF markets being used for speculative purposes, which can lead to increased volatility in onshore currency markets?
My first thought is I should have asked you to remove this question with my boss sitting here, but okay, strictly, if you ask me, and at least the work which in the Reserve Bank we've been trying to do on the regulatory side last 4, 5, 6 years, I think the broad thought process is a very simple thing, that markets exist for hedges, markets become liquid by speculators, and markets become efficient by people who arbitrage. I don't think I need to explain this to the audience here. So a certain amount of speculation, if we want our markets to be liquid, it has to be there. Now that speculation can take various forms. Let's say you have a corporate now, free cancellation and rebooking is allowed. The corporate has underlying. The corporate can hedge when it wants to. It feels the rupee is going to move in a particular direction. It cancels, re-hedges. This is speculation, taking a view on the rupee. Every entity has a choice of remaining unhedged. You could say that is also speculation. You're taking a view that the rupee is not going to move against your favor. So now it's about banks doing it. And frankly, we have, as I mentioned earlier, we have limits in place. We have the NOOP limits in place. Most of you have board-approved NOOP limits, which is well below what is allowed by the regulations. Difficulty sometimes comes when, as Prasanna mentioned, all Indian banks are on the same position. And instead of profiting from the world, you're trying to profit from RBI's actions. So I think maybe there we could have a little bit of concern. But broadly, I think within the set limits, all this is part of the market. Let me not say more before I get myself into trouble.
Thank you, ma'am, for being so candid. Now probably the last question, because I am already seeing some glances from that side. The same question for both of you. I may want to make my life easier. Prasanna ji first. Are there any asks you have from the regulators or the members which could help in expanding Indian banks' roles in these markets?
No, so I think Vijay spoke about onboarding and KYC requirements. That's something. Simpler and predictable tax laws. These are two things which are, we think we should try. I mean, it's a motherhood statement, I know, but I think we can work towards each one of this. Also review withholding tax on interest paid on the bilateral postings that happen. I think that is also something that is not, that's a kind of a pinprick for people who do these bilateral postings across geographies. The other thing is, encouraging foreign banks to run a much bigger position onshore, I think is something that, that's the broader thing that we should do instead of them running positions abroad. And for that, I would say that the regulatory nudges from the Reserve Bank should come down. Over a period of time, we should be allowed to run positions. And the LEF framework, which has been a hindrance for foreign banks running a bigger exposure. I think that is something that works. Just one more thing, sir, I'm not very sure about this, but the PFE exposure on CCPs, banks are doing it on gross basis and not net basis, which is kind of an irony because when you do a bilateral, you can do netting, but when you're trading through CCPs, you have to produce capital on a gross basis. I think this is a quirk of irony, I would say. So I think these are 3 or 4, maybe one of them on nitty-gritties, but broadly conceptual asks.
That's quite a long list actually. In so many short words you have said that. So Vijay, though he has answered most of your questions, your wishes also, but what would you like to add to the list?
I think nothing more. I think in terms of foreign banks, I think LEF, yes, especially in terms of derivatives, this is something which is slightly unique to India. So the ability to do back-to-back hedges with global clients get significantly constrained because of these limits. But at the same time, we're trying to work out with the clients in terms of directly accessing LCH as an example, or getting the clients onboarded to deal onshore. The other one, I think obviously the initial margin, again, it's more the regulations are out, it's more for the industry body, including ISDA and the market participants and CCIL to get on board. I think that will go a long way in terms of freeing up capacity for banks to do, foreign banks especially, to do transaction with a number of, especially Indian banks and in some instances clients, because the global regulations for us are already live. Right, so it's a bit of a binding factor at our end, which hopefully this quarter we kind of cross the hurdle.
It's been a great learning experience actually. So many questions. I believe some of them probably starting from the history, going to what is going to be in the future, what is present. We have discussed all that, and some asks already have been made from the people in this room, in the big room which we have. So I believe all of us would have. Do we have question answer or we don't have? We don't have. He says we don't have, time is not there, and especially since coffee break is there. So what I would request, if anybody has a question from any of the panel members, at your own peril you can ask them during coffee break. But I really appreciate all 3 of you being here, answering all the questions. It's been wonderful to have you here, and we got some good insight. Thank you.
Thank you.
Thank you very much, sir. May I request the panel members to please stay on the stage for a moment, and at the same time we'll request 2 of the beautiful ladies from FEDAI to please come over here and hand over the mementos as a token of our respect and appreciation for the panel members. Thank you very much, sir. I don't think we could have had a better discussion where market participants making their laundry list known and also expressing their points of pain very subtly, and regulators also giving enough hints, etc., what is there in the offing. Thanks a lot. I know we are set for a coffee break, but before I go into that, as we already mentioned that FEDAI keeps running various kind of quizzes. One small quiz I would like to have here. We are talking about the rupee internationalization. We are talking about rupee onshore, offshore, etc. We all know that symbol of rupee, INR, is devised by which entity? Which is the global body which gives the symbol INR? ISO. That's not the question. ISO is the global body which gives the 3 alpha symbols for all the currencies. What I'm asking is what's the numeric symbol of INR? ISO also gives the numeric symbol for all the currencies. Let's see how many people can do the Google fast. INR for rupee, we all know that's from ISO. ISO also gives the numeric symbol for all the currencies. What's the numeric symbol for rupee? 4217 is the ISO code 4217, which gives the alpha symbols. ISO 3166 is the system under which they give the numeric symbol. Okay, we let it pass, it's 356 by the way. Okay, the easier one now, which is right now there in the news also, who designed the current symbol of rupee? That's a controversy right now in the news. Son of Tamilian politician, that's close. Uday Kumar. Who was the first one? I don't know. So many people saying that. Okay, we have got a small gift for you. Do you have the full name? No, that we already know. Okay. Thank you very much, sir. We break here for a coffee break. Maybe if you permit, can we come back in 20 minutes so that we have got the next round panel as well as a presentation by CCIL.
Platforms through ClearCorp. We have 8 trading platforms, so almost platforms in all the areas in which OTC derivatives are there. Then we also issue LEI to the financial market entities as per directives of respective regulator. This year we have also formed a new company, new subsidiary company called CCIL IFSC Limited. This is to provide a real-time gross settlement in US dollar. So again, one of its kind in the Indian onshore market. So it will be a local US dollar clearing in GIFT City. I'll discuss in a little bit detail in the subsequent slide. So some of the developments in Forex in last few months by CCIL. FX Clear, there were 2 platforms, FX Clear and FX Swap. These have been merged in a single platform with a new technology, which is much, much faster and efficient in terms of dealing efficiency. New instruments have been rolled out on those platforms, so rolling forwards, quarter in quarter, 4 instruments. Then, apart from security features, introduction of user management, so all the user functionalities have been transferred to at the member level, so you can change your password, create your new user on the platform yourself. On the FX retail side, the PI utility, the participant interface through which everything starting trade processing to customer onboarding, etc. are automated. So that has been provided multiple applications of PI at the members' request. The overall limit on the settlement side has been increased from 300 to 500 million. On the spot side, it is 3 times, so from 900 to 1.5 million limit is there now. And last few months, we have not seen any limit breach by members in the spot segment. We are still working on higher limits. On the settlement side, additional settlement bank has been introduced, HSBC as additional settlement bank in the dollar rupee segment. So this should reduce the concentration risk with one settlement bank, 1 or more, 2 settlement banks. So now we have 4 settlement banks, Deutsche Bank, Wells Fargo, Bank of America and HSBC. I think as mentioned, guaranteed forward settlement tenure has been increased from 13 months to 36 months. Standalone primary dealers are allowed as been given license as authorized dealers. So they are also, these entities are also becoming members of CCIL in the Forex segment. So the segment agnostic collateral, member common collateral, instead of ACF, now it is member common collateral. It is not tagged to security segment as it was earlier. Funds withdrawal time has been extended by 1 hour. So from 2:30 it has been made 3:30. C notice, which is a notice for collateral withdrawal, pre-funding, etc. has been enhanced, and the earlier e-notice has been withdrawn, disabled. And the government securities lending transactions settlement has commenced under the security segment. Now Sarvam, which is a neutral infrastructure for non-centrally cleared OTC derivatives trades, though it is active since May 2023, will be made operational from 1st April 2025. It provides valuations, margining, both variation and initial margin, collateral management, risk analytics services for non-centrally cleared OTC derivatives. Bond forward reporting to CCL Trade Repository will commence from May 2025. As you are all aware, all members are required to report forex interbank and client trades, outright cash, term, spot transactions to CTL TR in phased manner. So 1 million, equal to 1 million or more than 1 million are required to be reported effective May 12. And forex contracts which is equal to or more than $50,000 are required to be reported from November 10, 25. Happy to inform you that LEI is the winner of Transparency in Global Financial Market Challenge from GLIFE at Paris, where we received the award along with RBI. Thank you. So the new company of CCIL subsidiary, so CCIL has about 58% stake and there are other 7 banks which have equal stake in the company. So this company has been formed to provide real-time gross settlement in dollar in GIFT City. So all the IBUs present in GIFT City would be the direct participants. The transactions among IBUs and their customers will be the starting phase where fund can be, US dollar fund can be transferred from one IBU to another IBU or one customer of one IBU to another customer of another IBU in GIFT City. So it is going to be, to start, when we start it will be only transaction in the GIFT City and starting with dollar. So we have received the software which is currently we are testing. The messaging format will be ISO 20022. We have already selected settlement bank, Standard Chartered Bank as settlement bank to provide the settlement activities. Similar to Infinite, in India we have Infinite which is a private network in India. Similar to Infinite, we are also forming a closed user group network in GIFT City. So that this CUG will be used to provide FCSS activity in GIFT City. So currently, it is in advanced stage of development. We have received the software for testing. And once we are ready with our own testing, internal testing, we will integrate with all the IBUs as and when IBUs are ready. We will also integrate with settlement bank. And we are targeting to go live in June. So some of the projects which are under pipeline. So in FX Clear, we are developing instruments beyond 12 months. So since we have got approval and we have gone live with forwards beyond 13 months. So correspondingly, those instruments will be available on the trading platform as well. We are also working on the APIs. So currently, APIs are provided for spot instruments. So the APIs will also be provided for forward and swap instruments. On the FX retail side, it was announced by RBI in the monetary policy that Bharat Connect, which is a subsidiary of NPCI, will make interface with FX retail platform of CCIL. And in that regard, we have started development of the platform and interface. We have also called a meeting of member banks in the next week, and we are targeting to go live for this platform sometime in April. So the advantage of this platform would be that all the customers of Bharat Connect, which are using their bill payment services, etc., will be eligible to connect through that services to connect to FX retail platform, and they can buy and sell foreign currencies. To start with, in phase 1, it will be only buy and only for retail customer. We are also planning to introduce other currencies on FX retail platform. We are also working on mobile platform, mobile application for the FX retail platform. On the forex settlement side, we are working on the merger of two segments. Forex, currently, as you are aware, there are two segments, the spot segment and forex forward segment. And now it is high time that we go for merger and make it single segment. CLS services, which are being used by all the private banks and nationalized banks in India, are now available for IBUs and as well as overseas branches of Indian banks. So we are talking to some of the nationalized banks which have overseas branches, and that services are also going to be made available. We are also working on, as you are aware, that clearing member structure is available in the forex segment, where spot and forward trades of your constituent and clients can be settled through this segment. So we are enhancing the system to include cash and term transactions as well. Again, as Madam says, we are also working on to provide NDF trading and settlement services. We are also trying to introduce MyFor trading on Astra trading platform and CC clearing services up to 10 years. So currently it is provided up to 5 years. So it will be extended up to 10 years and it will be going live from 17th March. We are also working on FX options platform and CCP services, and that will also be made available and launched shortly. So these are the services which have been developments in CCIL and going forward. So if you have any questions. Thank you for your time and attention. Thank you.
Thank you, Kamalji, for taking us through the journey of CCIL and for being such an integral part of the growth development of the FX market. As you know, now we are coming to the last but not the least event of this conference today. But before that, I would like to just share some personal experiences. When I joined FEDAI a few years back, I was thinking maybe moving away from the direct participation in the market, I won't have to worry about the VUCA element, the volatility, uncertainty, complexity, etc. But like many other times, whenever I tried to take position in the market, here also I was proven wrong. Why I'm sharing this today? Because today is the time when I'm facing the uncertainty and complexity, both the things at the same time. As you know, our next panel, the moderator for the panel, as we have already circulated, was supposed to be Sri Vivek Wahi, Executive Director, Central Bank of India. But because of certain other exigencies, he has not been able to make to this conference today. So the first challenge for me is now to find an alternate. And for that, I'm taking the liberty of requesting our another panel member, Mr. Srinivas Panigrahi, to please, I request him to, if you can take the responsibility of not just a panelist, but also being the moderator for that. Please, welcome. And sir, before I leave the stage to you, requesting you to please invite your other co-panelists and to introduce them. One more thing, as I can see, there are 4 chairs over there, and Mr. Vivek Wahi not being there, I have to just nominate one more panelist for this conference, this panel discussion today, so that the discussion can go in a proper manner and we can get all the possible views. And for that, I'm again taking little bit of liberty over here. May I request Shri Baldev Prakash ji, Deputy Managing Director, State Bank of India, to please, if you don't mind. surprise I'm throwing over here right now, and please. Over to you, Srinivas.
Yeah. Respected RBI Deputy Governor Rajeshwara sir, and SBI MD Ram Mohan Rao sir, and ED RBI RS Ratho sir, and Madam Dimple Bhandia Madam, and senior management of SBI, and other banking professionals, visionaries, partners. Good evening to all. At the outset, I would like to thank FEDAI for giving this opportunity to me and as well as the panelists for this panel discussion. Thank you, sir, Ashwini sir and Chairman FEDAI for this opportunity. I also would like to thank our SBI's DMD, Baldev Prakash ji, for accepting the request for becoming panelist for today. It's a very short notice for him, but still he has accepted. Thank you so much, sir. On my behalf and on behalf of FEDAI, I would like to extend my heartfelt gratitude for having accepted this request. And also now I request other panel members. Dr. Aditya Ghaya sir, CGM in charge, Foreign Exchange Department, RBI, to come on to the stage. And Dr. Aditya Ghaya sir has completed his BE honors in electrical and electronics engineering and MSc honors in physics from BITS Pilani. He also holds degree in law and finance from Cass Business School, London. He has completed his PhD in economics from IIT Mumbai. He is a certified associate of the IIB&F. And Dr. Aditya Ghaya is with Reserve Bank of India since 1996 and has over 28 years of work experience in the areas of payment systems and information technology, public debt, banking and non-banking supervision, exchange controls, and reserve management. He has rich experience with multilateral agencies, having worked as Director of Finance with the SARC Development Fund headquarters in Bhutan and as Senior Finance Sector Expert in the area of exchange controls with the IMF headquarters in Washington, D.C. Presently, he is Head of the Foreign Exchange Department in the Central Office of the RBI Mumbai. Now I request Sri Arup Rakshit, Group Head Treasury, HDFC Bank, to come on to the stage. Yeah. Thank you, sir. Sri Arup Rakshit is the Group Head Treasury of HDFC Bank. He leads the treasury of the bank and is responsible for all the functions, namely ALM for the bank, customer business and for FX and interest rates, bullion business, bond sales distribution, sales and distribution, FX and interest rate trading. Additionally, he is also responsible for the Gift City branch. He joined the bank in 2006 and has held leadership roles at Treasury Sales earlier before taking over as the Treasury Head. He has a rich working experience of more than 31 years. Prior to joining the bank, he worked with Deutsche Bank and ABN AMRO, where he was in charge of Treasury Sales. He holds a BTech degree from Indian Institute of Technology, BHU Varanasi, and a master's degree in Business Administration from IIM Calcutta. He is an active member of Management Committee FEDAI and India FX Committee. In his free time, Sri Rakshit likes to read ancient Indian literature and enjoy watching sports. Now I would like to introduce about our SBI's DMD, Baldev Prakash ji. Sri Baldev Prakash, DMD and Group Chief Risk Officer of SBI, is a career banker having a rich experience of 34 years. Having joined in SBI in 1991 as a probation officer, Sri Baldev Prakash ji has an illustrious career with rich experience of working in various segments of banking, majorly in retail banking, leading him to a place in the coveted SBI Chairman Club in 2013 and 14. Recently, he has completed a very successful 3-year tenure as MD and CEO of J&K Bank, transforming the bank 360 degrees by bringing path-breaking improvements in financial, technology and governance structure. Sri Baldev Prakash ji also had a successful tenure working as India-based officer at Muscat from 2007 to 2011. He is working as Group Chief Risk Officer at SBI from January 25. Now coming to the today's panel discussion, it is the last program. We know the difficulty for the participants, but still we will try to make it as lively as possible. RBI's Executive Director R.S. Ratho sir has already touched upon about the SROs. The topic for discussion for this panel is evolving role of SROs in changing regulatory landscape from directions to delegation. We are all aware SROs are non-governmental organizations. These are established by the industries or organizations which they regulate. SROs are responsible for setting the standards. They are also enforcing these standards for conduct for their members. They operate independently but under the oversight of the statutory authority like RBI and other statutory authorities. The primary objective of an SRO is to complement the regulatory framework. There are multiple benefits due to these SROs. The benefits are one, industry expertise they can provide, and they can reduce the government burden. Third would be flexibility. Fourth, better compliance. They set the industry standards, resolving the disputes within the sector itself. They also play a critical role in capacity building, knowledge sharing, industry-specific, sector-specific knowledge they keep sharing. And again, they also enhance the confidence of all the stakeholders through self-policing. And there are also some challenges for these SROs, like conflict of interest. Again, enforcement of limits, the monitoring part, and also potential dominance by large players within that sector. Fourth is fragmentation. Likewise, there are some disadvantages or some challenges. And in this panel discussion, in the next 40 to 45 minutes, or whatever, max, we will try to close as early as possible. We will be discussing, starting from the historical role of SROs and how the SROs evolved over a period of time, and what are the key factors that have driven the shift from directive to a more delegated model of self-regulation, how FEDAI, FIMDA, YAMFI and other SROs are shaping the banking sector in India, what structural or policy changes would further strengthen the role of these SROs in India's financial ecosystem. With this brief intro, I would like to ask the question to Dr. Aditya Ghaya. Sir, self-regulatory organizations have played a crucial role in maintaining market integrity and best practices. Over a time, their role has transitioned from being directive-driven to a more delegated model, aligning with evolving regulatory landscapes. Given this transformation, I would like to ask this question to you. How do you describe the historical role of SROs and how has it evolved over a period of time? What key factors have driven the shift from directive to a more delegated model of self-regulation?
Thank you very much. And at the outset, good evening, namaskars, and happy Holi to all of you. And of course, I was wondering why we are having it on Holi, but then Having said that, so SRO historical role actually, our ED Ratho Sahab has also explained, so I won't go too much into the detail. In various areas, especially in the area of financial regulation, in certain jurisdictions historically, sometimes SROs have even preceded formal regulatory authorities or statutory authorities, and then over a period of time when the statutory authorities have come up, they have actually followed the kind of framework which has been laid down by the SROs and then taken it up. In many cases, it has been the other way around, when statutory regulatory bodies have been set up first and then SROs have followed through afterwards, once the regulated entities become mature enough and they have that degree of confidence to understand that laying down the rules of the game are much more in their interests in the long term, so then they come through with that. So sometimes it's the other way around. In the case of India, if we look at, especially with regard to the question of why we are having more of delegation now, if you look at it, last 10 years or so, we have started having more, focus towards principle-based regulation and also principle-based supervision. So in case of the supervisory thing, if you look at the Reserve Bank's supervisory framework for regulated entities, it has become more and more principle-based. We have a risk-based supervision. So we look at things more from a forward-looking angle. We don't go so much into the transaction part of it. And therefore, we understand that the players are mature enough to take care of the compliances which are there in general. And more so because the regulatory framework is at times not possible. We don't have that possible to make it so flexible at times. And keeping in mind so many disruptions, technological disruptions which are there, and other developments which happen, we expect that SROs will be able to take care of the delegated rules. So more and more principle-based things. In the Indian context, if you look at the recent thing, we have had the trade guidelines under FEMA put in public domain. If you would have seen that, you would have seen that there's a lot of delegation and there's a lot of principle-based kind of way forward for trade guidelines. So if you look at it, we are looking forward to an SRO like the FEDAI to put the focus on its constituents, work with them so that they can in turn form entity level principle-based kind of processes so that the trade guidelines are becoming very liberal, and it releases the entire external trade. We are able to achieve the overall national objectives of 1 trillion. So this is one of the reasons. Technological advancements, again, we cannot keep on changing individual regulations. We want to move away from prescription-based regulation. So as we move away from prescription-based regulation, it becomes necessary that the regulated entities regulate themselves. They share with each other the experiences they have, and based on their shared knowledge, they are able to move forward on a basis which is more delegated rather than supervisory or the regulatory bodies prescribing it.
Thank you so much, sir, for the elaborate explanation. Now we will go to Aruprakshitji. The role of FEDAI and other SROs in India's banking system has been evolving, especially in forex and trade finance. With increasing globalization and regulatory shifts, their influence is set to grow further. Looking ahead, how do you envision the role of FEDAI and other SROs in shaping India's banking sector in general and forex and trade finance landscape in particular?
Thank you. Thank you, sir. I think Dr. Gaya already mentioned that on a principle-based approach, how things will look like. So let me start from there. But before that, my apologies, the discussion would be more on a general stance. So if I make some statements which can go against some general principles, my apologies beforehand itself, because this is a more structural discussion. So I think moment you are getting into a principle-based approach, which the regulator has highlighted, and now even in the trade side, the larger challenge comes in that there needs to be a lack of regulatory arbitrage should be there between market participants, because that can disrupt the market. And the idea is that the market should not get disrupted. And that's where I think FEDAI has a very large role to play in the trade part. FEDAI has played a role, and overall we have evolved in the forex market. So forex market is a lot more evolved in that state. But trade needs a lot more, because we have, for 75 plus years, India has worked on a prescriptive model of trade. Now, when we are going into a principle-based, we will have to be very careful. We saw that when we moved in the foreign exchange in 2020. Now, that came in the middle of COVID, so activities was a little less, so it was easy. And I remember the number of discussions where the market participants have had during that phase before introducing that in the system. So, and trade is a lot more complex, and there are a lot more complex part of it. So I foresee FEDAI coming into that in a much more strong role, which we have to do, and we have to take this forward in that sense.
Thank you, sir. Now we'll go to the third panelist. Technology, especially AI and ML automation, is transforming the regulatory oversight by improving surveillance, compliance, and risk management in financial markets. In this context, sir, how do you see the role of technology, particularly AI and automation, in enhancing the oversight capabilities of SROs in the Forex market?
Yeah. Thank you, Srinivas. Good evening, everybody. So technology is playing a significant role in all aspects of our functioning. And the role of technology in functioning of SROs cannot be undermined. What I see, the amount and the complexity of data, which is increasing every day, it is very much needed that this data should be analyzed effectively, proactively, by way of using the technology tools, particularly the AI tools, and then arrive at the proper market insights and sharing it with the participants as well as with the regulators, so that the effective, proactive risk management and the fraudulent activities can be checked proactively. I believe the importance of technology is going to increase every day. The amount of data and the complexities are going to increase. So having said that, number one, then the second thing which is very important is now we have to have a continuous monitoring of data on the go. And without the effective technologies with AI and ML tools, it is just impossible to do that. Are we able to, we have to do it, and we are able to do it with the improved technology tools, so that the better risk management and the compliance is ensured in the participants, as well as the proper insight is given to the regulator. And the third usage which is coming to my mind is for developing the effective models for proper risk management in future. We need to have the correctness of data for developing that models. And if the data has been generated with the more usage, effective usage of technology, I think the effectiveness of models going forward can be much, much better. So that is what my take is.
Thank you, sir. Now coming to Aditya Gaya, sir. With RBI introducing a structured framework for SROs few months back, particularly in the fintech space, there is growing discussion about the role in complementing or potentially overlapping with the existing industry bodies. As the financial landscape evolves, it is important to assess how these entities coexist. Given this backdrop, how do you see recognized SROs contributing to financial landscape? Do you see an overlap of existing industry bodies and new SROs?
Yeah, so I'll limit myself to some extent to the foreign exchange regulations part also. And just to give you a brief on the foreign exchange part also, all the authorized persons, although we have an existing SRO, which is the FEDAI, we are working on a framework which we will actually bring in force very soon for the authorized persons, where we will formally kind of allow entities, including FEDAI, to register themselves and become formally SROs in the foreign exchange area. Now, having said that, and looking at the kind of possibility of kind of overlap between the activities of industry bodies and SROs, my take is that SROs are having certain governance structures which get defined, which make them, owned in a decentralized way. Every industry partner who's there comes in at an equal level as an equal partner in the SRO. So the possibility of monopolistic tendencies taking over, which are likely in terms of industry bodies, is very less. So obviously the role of regulation insofar as the exchange controls or any such financial regulation is concerned, the SRO will have to take the primary role because it will be much more neutral and because it is created as a structure to form the bridge between the regulated entities and the regulator. Insofar as industry bodies are concerned, their objective will be slightly different because they will bring to fore whatever important issues are there and developments are there in their particular industry and try to see whether they need to have some kind of regulatory oversight or whether the regulatory oversight is there which needs to be changed. So they are more from a different perspective, more from the regulated entities perspective, whereas an SRO has a more neutral role to play. So the governance part, which will also in fact get very comprehensively covered in the guidelines which we have been discussing with FEDAI for a couple of months now, will also take care of this, that the SRO becomes much more representative and it will therefore, I feel there will be no kind of conflict in that sense. The SROs will have their own role and the industry bodies will have their own kind of take.
Thank you, sir. Again, sir, one more question to you. These SROs are nowadays in this era of where financial markets are more interconnected than ever. Cross-border transactions come with increasing complexities. SROs must navigate different regulatory regimes while ensuring consistency in standards. Given this backdrop, in a globally interconnected market, how do these SROs address cross-border challenges?
Yeah, so this is actually becoming more and more important and a lot of examples also can be given here. Because what is happening, especially if you look at something like exchange controls, we still have capital controls which are in place. Many other jurisdictions don't have that kind of capital controls. And as our regulated entities start functioning in other jurisdictions, they will have to tread carefully because they have to conform with the regulatory framework of different jurisdictions as also in India. And with the kind of presence that we have today in terms of our regulatory entities, our banks and financial institutions operating outside India, their role and their presence outside India continues to be very minimal. So the kind of influence they can have on regulations outside India will be again very minimal. So that becomes a very big challenge for them because they have to not only comply with regulations of an overseas jurisdiction, but also they will then bring in pressure to the domestic regulators that they would want certain changes so that they can comply with both the jurisdictions at one point of time. So this has become very complex. Suppose you look at something like, internationalization of INR. This has become very evident here because when we are dealing with various countries where we have signed local currency arrangements, we find there is a differential regulatory approach in many of these jurisdictions. We have signed a local currency arrangement with the UAE where absolutely no capital controls are there. We have signed a local currency arrangement with Indonesia where they still have capital controls and probably much more rigid capital controls than we have in India presently. So we are finding that a bit of an issue because we cannot prescribe something which is going against the kind of capital controls and the calibrated path that we are following today. But we have to also, bring on board entities from Indonesia or UAE who will be functioning here and vice versa. So then the SROs require, the kind of role becomes very, very important because they will have to actually guide the regulated entities as to what can be done in other jurisdictions and how they can actually look at the regulations onshore and offshore and have some kind of a common ground where they can meet the two regulations separately. And this is becoming more and more important. We are finding this as a challenge, especially with respect to some things which are slightly more controversial in the sense we have, third country stipulations put in place at points of time, and we have our regulated entities quoting those third country stipulations, and saying they would not like to do INR to INR transactions because of those third country stipulations. I think the indication and hint I am giving is sufficient for all of you to understand. But I find that very restrictive, very conservative, because I find sometimes the regulated entities, especially when it comes to foreign exchange, are more conservative than the regulator itself. And that should not be the case. So this is something where the SROs have to come in, because we cannot give a guideline in these areas from a regulatory perspective, but the SROs will have to do some kind of moral suasion. And this is where SROs is very important, because they will provide that moral suasion between the regulator and regulated entity to see that these transactions are taking place in a seamless manner. Thank you.
It would be more challenging for SROs as well.
Yeah, I understand.
Yeah,
I
yeah.
understand.
Now over to Arup Rakshitji. For any self-regulatory framework to be effective, market participants, all market participants, must have confidence in its fairness and transparency. Since SROs are industry-driven entities, trust building becomes even more critical. My question to you, sir, how can SROs build credibility and trust among market participants when they are industry-driven entities?
So let's start with looking at one of the, whether it's an official SRO or not, but recognized in that sense is ISDA. Now, ISDA has been there since 1985. It has gone through various different economic crises, but it stands itself, and it actually has a respect across 75 countries who have signatories to ISDA. So that has evolved. Now, if you're saying that as market participants, we are also part of the SROs, and how this will, how one builds trust, effectively there has to be mutual trust between participants in a market, mutual trust between the SRO and the regulator and SRO. So it has to be a mutual trust. Now I'm reminded of an old story by Munshi Premchand, Panch Parmeshwar. If anybody has read it, they will realize what it says, that as you become so the story goes that a very low, economically lower end of the strata guy is made a panch, sarpanch, and obviously people are making fun of it that we can manipulate this guy, but when he sits on that chair, he becomes a neutral guy. So it's like how jury system used to work. If you have to, there has to be a trust coming in, and I don't see a reason why there would be a conflict. Yes, there will be some larger players, some smaller player, but once you're sitting on that panel, everybody is equal. So it's an evolution. If there may be initially conflicts, some of the decisions may be going against some of the big players, but it is an evolution. If you have that mutual trust, it will stand it on its own.
Thank you, sir. Now over to Baldev, sir. Recently, FTX got collapsed. The collapse of FTX has reignited the discussions on the need for stronger regulatory oversight in the cryptocurrency space. While government regulators are still defining their approach, some SROs could play a role here. Some believe that SROs could play a role there. So how do you see SRO may be suited for this segment of cryptocurrency space?
So I believe that SRO is a very cost-effective mechanism working between the participants and the regulator. FTX is a significant incident, but what we have learned from this incident, are we having an effective governance structure, having proper governance standards, and the learnings from this incident is properly shared with the participants, and the corrective steps have been taken. I think that is the role of a SRO.
Yes,
I believe if we take these factors into account and then improve the standards, improve the governance standards, improve the accountability and the transparency in the system, there is an important role for SROs not only to stay but to improve upon further. that is what I believe. I think SROs should continue evolving, as Mr. Arup has said. The trust factor is very, very important from the regulator side also and from the participant side also.
Okay, sir.
Over to Aditya Gaya, sir. As SRO gain more autonomy in regulation, how can they strike a balance between compliance enforcement and market development? Do you foresee a potential risk of conflict of interest? This is the challenge which we discussed earlier. This is the major challenge for SROs. As they are within that industry entities, within that only they operate. So there is a potential risk of conflict of interest. How do you foresee this potential risk of conflict of interest?
Yeah, so again, coming back from the last maybe 1 or 2 years experience, as I mentioned, we had moved to a more supervisory kind of framework which was principle-based, risk-based. And but the last 1.5 years, we have tried to associate ourselves to do some kind of transaction testing with individual supervisory teams which have gone to the authorized dealer banks. And we have found a large gap which is there. And we have then found that, the banks have had a lot of difficulty with respect to having people who are having the right set of skill sets because they get transferred frequently. And, the role of the SRO in actually keeping the entire set of people who are dealing with foreign exchange transactions, for example, updated, rests on the SRO and also the individual regulated entities. And therefore, the compliance part of it, as we move on to more and more principle-based regulation, will have to rest on the regulated entities, and the SROs will have to come in the picture because they will have to guide them, so that the common kind of principles are adopted, and there is no disconnect, and the communication also between the regulated entities and the regulator takes place through the SRO in a much more efficient manner. For example, recently we had this issue regarding SBLCs issued against non-resident deposits. I think some of you at least who have been associated will be aware. So there was a lot of communication gap between what we had said and what our regulations had said earlier, and the way the market was interpreting it in the last decade. And then when we gave certain clarifications on it in October last year, again some communication gap was there. So immediately we had FEDAI, they came to us, they asked us, we gave them the clarification and requested them to circulate it to all the chief compliance officers of the AD banks so that the uniform communication goes to all the banks, there's a uniform interpretation, and therefore the compliance part of it actually becomes much more and more important. And I believe that market development and compliance are not, they are not at odds with each other. They are not conflicting with each other, because market development can only happen when the rules of the game are set right. And if the rules of the game are not there and there is total jungle raj, then obviously there can be no room for any kind of market development at all, because you will have conflicting, objectives which are there of the regulated entities. They do not know where is to draw the line, what kind of transactions are allowed, what are not allowed. So there is no conflict there, because unless and until, and that is something which all commercial entities realize as they mature, that unless and until the rules of the game are there, they will not be able to actually even get a commercial benefit out of anything. So this is something which is going to have to be put in place, especially if they do have some area where they violate the guidelines and the enforcement is very strict in terms of the penal and other penalties that are enforced by the regulator. So therefore the compliance part and the market development are not at odds with each other, and the SROs in fact are the best suited to take care and draw the balance between the two of them. Now in terms of the conflict of interest, this mostly gets taken care of at the governance part. So if the SROs are well governed, if the regulated entities are well governed, which are anyhow prerequisites for any kind of a principle-based regulatory framework, because principle-based regulatory framework comes in only when the market participants are mature enough. and that we understand that the market participants after 75 years of independence are mature enough. And that is why we are moving into a principle-based kind of a thing in every area, whether it's banking regulation or foreign exchange regulation. So therefore, we understand that part of it. So if the governance structures are in place, I believe there will be no conflict of interest. Thank you.
Sir, challenges are not many, but advantages, benefits are many due to these SROs. So one more question to you. How you are going forward, how you are looking at these SROs playing a role in fostering market growth?
Yeah, so in fact, as I was mentioning earlier, we are finding a lot of conservative, thought in the stakeholders themselves. We have come across instances where, for example, in the INR part, as I was mentioning earlier, banks have gone to the extent of advising their constituents that don't do the INR, dollar is better. And personally, I have had this because 2 weeks ago, I was in Colombo. I interacted with one of the largest importers of onions and other consumable vegetables in Sri Lanka. And there were two brothers who had been doing this for the last 40 years. And I asked them why they can't do it in INR. They said their onion contractor or the exporter from India disagrees, he doesn't want to do it in INR. So I asked them to put up a direct call to the onion contractor in Nasik. And I talked to him and I asked him what was the issue. He said, there is an issue because this is going to lose out because of the rupee devaluation. So then I said, you tell me one thing, what are your input costs? Are they all in rupees or in dollars? Are you putting dollar inputs into your farming for onions? So he said, no. Then I said, what is your problem then? He said, I went to my banker. I won't name the bank because it's not very good to do it here. But he said, I went to my banker and the banker said, no, don't do it in INR. It's too complicated for us. Do it in dollars. So that's why they're doing it in dollars. So this is what I'm saying, there's something we look forward to institutions like the FEDAI to bridge this gap. We're looking for regulated entities to bridge this gap through the SROs and bring about the changes. We are all talking of a paradigm shift. A paradigm shift can never happen. Paradigm shift is always something where you have to break through the barriers which are there. This paradigm shift is not going to happen unless SROs and regulated entities look forward to what we are trying to aim and make the objectives, as our Deputy Governor was saying, by 2047 we want to become a developed country. But we can't do that unless and until all of us make that paradigm shift. So we are looking forward to the SROs and the regulated entities to break through all the things which have already happened in the past 75 years. Unless we do that, we won't be able to move forward. So this is our expectation. Thank you.
I believe, sir, these SROs will definitely bring in paradigm shift in the financial ecosystem. Now, question to Arup Rakshit ji. With rapid advancements in fintech and decentralized finance, traditional regulatory frameworks are being challenged. The question now is whether SRO should take an active role in overseeing these innovations or allow market forces to shape their adoption. What's your perspective?
So let me take a step back and start from where Dr. Gaya was mentioning. So what you are suggesting is that the fintechs are doing disruptions, right? I think first of all, and I am representing a FEDAI here, first of all, FEDAI as almost a SRO since it's pending, we should disrupt ourselves. We are also not in a position to play the correct role of a SRO in the way it is being envisaged if we are still following the old method of disruptions, or old method of working. Disruptions is a double-edged sword. So what fintechs are doing is a double-edged sword. Disruptions has a lot of positive and a lot of negativity also into it. As a normal market practitioner, I don't want disruption. Disruptions will create unnecessary chaos, and as a banker, I will have to change my processes, policies. But disruption is there for reality. And unless we acknowledge that disruptions is going to be there, we cannot move forward. So what happens there? The disruptions have to be within boundaries. The boundaries have to be qualified as what it is, and there is the role of the SRO comes in, that you have to govern the boundaries. You can't be allowing complete unregulated disruptions to happen, because then it can really disrupt a market, and if a market issue happens, then the confidence goes, and you're looking at a country confidence level. So you cannot allow that. But within the framework of the boundary, you'll have to allow the disruptions. The boundaries will keep changing. The boundaries, in fact, it's not a square boundary anymore. It's a square box anymore. It's a completely an amoeba kind of a scenario. So it can grow in any form and shape. So you'll have to keep a watch on the boundaries, but keep it within the boundaries.
Thank you, sir.
If I can just
You
add,
can
so
supplement.
he was rightly saying disruption is positive and negative, but actually we're looking forward to some disruption from the regulated entities now, because we are finding too much of conservative thought. So we are looking for disruption, and as he rightly said, once a disruption happens, we can always fix that boundary together. We can sit together as a regulator, as the regulated entities and the SRO, and make that boundary. But the disruption has to happen, because unless the disruption happens, no paradigm shift. Thank you.
Over to Baldev Prakash, sir. This is the last question. It's good news for all of you. Yeah. Sir, while SROs play an important role in financial governance, there is always room for improvement in their structure, powers, and accountability. To further strengthen their impact, what structural or policy changes would further strengthen the role of SROs in India's financial ecosystem?
Yeah, I think a very, very pertinent question for today's discussion. First, I think we have discussed it, all three of us, earlier also. Having an independent board and independent governance structure, and then ensuring that there's a trust, the integrity, and transparency and accountability in the system will go a long way in improving the overall SRO structure. And I believe the interactions and the coordination between various industry SROs, the financial and others where successful SROs are functioning nationally as well as abroad also, can go a long way in improving in the working and functioning of our SROs in the financial sector. The key functionaries are equally important. Are we exposing the key functionaries of our SROs with the best of the trainings which are available so that the appropriate corrective steps are taken in our functioning also, I think will help in going forward. And as we mature in the future, can we think of having some maybe statutory powers for SROs to enforce discipline among the participants? So that also maybe in future we can think of as a policy matter. That's what I want to say.
Sir, Dr. Aditya Gaya, sir, would you like to supplement with regard to the structural or policy changes which would further strengthen the role of SROs?
Yeah, so as he said, one of the things is governance, and the entire thing has to be very well diversified. If it is well diversified and it includes each and every, for example, the one that we are thinking of authorized persons would necessarily have to have the AD category 1, the AD category 2, 3, and also the FFMCs till they are there, because we have had the AP framework also put in place where we want to slightly have the FFMCs moving in a different direction. So we'll have to have each one of them come up. They'll have to take ownership. They'll have to be well diversified. Everyone will have to supplement, and as he rightly said, the training and skill development is very important. And that part of it is something I think which is something where we need to work very hard. Because as the things are evolving in a very, very exponential kind of a thing, AML or whatever, we have to take care of the artificial intelligence and machine learning and everything. All the disruptions we have to take care, we can only take care of it if we have a very well-governed, well-diversified and professional body as an SRO. And that can only happen once the skills development happens.
That's true, sir. All the organizations, including banks, are embracing AI, ML and all these enablers. They are taking a lot of initiatives. Arup Rakshit, would you like to add anything here? Yeah.
Currently, the way we have been working in the SROs, or at least related to the markets part of it, it's a lot more the banks or the financial institutions led, where the management team of the SRO itself is, there is some level of expertise at a top level, and after that it's more of a implementable team. I think that entire concept has to change. It has to be a very crack team across board, across various layers, with a more guidance coming from the market participants, rather than the market participants being the main players in that entire scenario.
That's true, sir. So, I would like to thank all the delegates for your kind attention and the patience. We have concluded this panel discussion. Again, I would like to thank FEDAI for this opportunity, for giving this opportunity. Thank you, sir.
Thank you, Mr. Panigrahi. Thanks for taking it through. Thanks for accepting the responsibility at the last moment and helping us. That's another example how an SRO can't succeed without the active support of all its members. If today you had not taken on that responsibility, maybe this event or panel discussion may not have been very successful. May I request, sorry to say, please come here for a photograph, and also request the two beautiful ladies from FEDAI to please hand over mementos to our panelists. Thank you very much. Thanks for your support. Thanks for the interesting discussions that we had. And it's always very pleasant to hear a regulator saying that we want more disruption. That's a key point which I take away from this. So, while we are coming to the last part of this program today, I have got one or two more questions to talk about. We all work in this financial market. We all, day in and day out, do a lot of calculations and the things. Today, we are all talking about the Holi, the festival, which, sorry to keep you away, hopefully towards the end, during the gala dinner, we'll try to give you a little flavor of that, not the bhang, but some other kind of liquidity. So, but besides Holi, today is another day internationally. Today's day, the 14th March, is celebrated, another day which is remotely related to what all we do in our dealing rooms all the time, the calculations, what we keep doing. Any idea anybody would like to mention? Pi Day. I was looking more for the mathematics day, but yes, Pi Day, the 3.14, the number which has been intriguing the world for last so many years. The first two decimals, 3.14, the March 14th is a Pi Day. May I request you to please come forward? We have got a small gift. Who was that? Thank you very much. So we have got few more gifts which we are keeping for the gala dinner. Maybe you're depending upon your performance before or after the drinks. We'll decide who gets that. Two stages, before the drink who performs better, and after the drinks who performs better. So with this, now I'll like to request our Deputy CEO of FEDAI, Mr. Srinivas, to come here to offer a vote of thanks for today's program.
Thank you, sir. So, when we started thinking about how the next conference would be, so the committee had two things to do. One was to select a place. The committee unanimously selected this part of the world, Switzerland and this city, as the best place to conduct or convene such a conference. Even though this is the second time FEDAI conducting the conference in Zurich, in 2012 also FEDAI conducted, and there was 2-day business session. Lot of things was discussed. And I think I'm not a part of that conference at that time. But today's discussion, it was very vibrant and more healthy because both the regulator as well as the market participants were sitting together. And the other thing was about the theme. With the India's financial markets and how we can navigate the volatility when there is uncertainty in the emerging world order. Especially, I believe that there was a few discussions here and also a very learning exercise, especially with the Honorable Deputy Governor's keynote address, followed by our MD, State Bank of India has also given about his experiences in the global markets. So we extend a very heartfelt thanks to Honorable Deputy Governor attending this conference and giving a keynote address on behalf of all our members. Similarly, I also extend my thanks to Ram Mohan sir for his also a detailed explanation on especially with regard to our theme. Next is our executive director sir also, Raj sir also has, as a part of the opening remarks, which subsequently rolled out the 2 panel discussions were also very interesting, and also apart from that, the main thing was about the 2 discussions we had from the both on the integration of onshore and offshore markets as well as the role of the evolving SROs. As we carry home every time after all these conferences, I think at this time we have a lot of things additionally to carry, especially the last part where the role of an SRO and the part of the FEDAI to play in the coming days. So I thank all the panelists who contributed to these vibrant discussions, and also especially the moderators, our chairman and the Panigrahi sir. Also thanks for them as in participating in this conference, and moreover, Kamal Sinhania has also explained about the capabilities and the products which as a CCP, the CCIL is offering to our members in a settlement side also, and the new products what they are going to introduce. Before concluding, I also thank the event partner, especially the Clearing Corporation of India was our event partner for the last several years of our conference. We thank them for their wholehearted support in conducting this conference in such a way and such a wonderful. And also the other 2 sponsors, the gold sponsors, the Bloomberg and the LSEG, and also the silver sponsor, the Deutsche Börse Group 360T, as well as the NSE Cogencies. Moreover, this year, we already started at the initial welcome speech also, chairman was telling that this year we have a tremendous interest shown from the members. 311 participants are attending this conference. This never before, and we all need to be proud of such a large gathering. And also we also see that the spouse and the family members, almost 47, we hope had a grand enjoyment, especially the chocolate factory and all. They had a tour today while we were sitting here. So I thank each and every member, delegate, and all the sponsors, as well as my team, which we started from October onwards to this end of the conference, and the wholehearted support we received from each one of you. Thank you, a big thank you. Once again we meet. So we are concluding this business session. As mentioned, we will continue with the performance and gala dinner, and the next 2 days also we assemble for other activities like a sightseeing. Thank you very much. Thanks once again.
मुझे रोक टोक कहते हैं लोग पर मुँह सा है मेरे जानू नश्तर है वो यही दूर दूर गूंजे फितूर पर बादशाह है मेरे जानू हाँ खड़ा भी है बोली दिल है रंगोली इसमें पक्का है क्या लोग देखते हैं मुझको तो दिखता है इसमें कोई सनम अंगारों का अंबर सा लगता है मेरा सामने ऐसा घर वाला मिल जाए तो घर वाली महारानी सनम सामे अरे सामे आजा सामे बरम सामे सनम सामे जाने दो दिल से चले जाने दो कह दो वो बुरा था बाय 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 बाय